Very good morning. So yesterday we started with the chapter of capital gains. Capital gains is from section 45 to section 55A. It is from section 45 to section 55A. So we started with saying that section 45 subsection 1 is the basic charging section. Section 45 subsection 1 is the basic charging section of this head, and in this way, in this head of income we are having multiple charging sections. So section 45 subsection 1 says that if four conditions are fulfilled, then your income can be taxable under the head income from capital gain. First condition says there must be a capital asset. Second condition says there must be a transfer of capital asset. Third condition says such transfer should take place during the previous year. And the fourth condition says such capital gain should not be exempt under section 54 series. See, out of four conditions, the third and the fourth condition are already discussed. It is only one line condition. Third condition says your capital asset should be transferred during previous year 2021. So that third condition is over. Fourth condition says your capital gain should not be exempt in section 54 series. That is also over. And then we started the discussion with respect to the first condition. What was that? There must be a capital asset. So to understand what is capital asset and what is not capital asset, we moved on to section 2 clause 14, which gives us the definition of capital asset, wherein we tried to understand that definition of capital asset is an exclusive definition. This is simplified for you in the form of a flow chart. So here we say that definition of capital asset is a exclusive definition. What all things are not capital asset is defined. What all things are not capital asset is defined. Rest all will be considered as a capital asset. So number one, stock in trade is not a capital asset. Number two, personal effects are not capital asset. But in that personal effects also, there are certain exceptions. Number one, immobile personal effects are considered as capital asset. Number two, some specified movable assets like jewelry, archaeological collection, drawing, painting, sculpture, work of art, all these things are considered as capital asset. Besides this, all other movable assets will not be considered as capital asset. Then we moved on to third point of exclusion, that is agricultural land. Here we understood in note number 2 saying that agricultural land situated outside India or in India in urban area is considered as capital asset, whereas agricultural land situated in India in rural area is not a capital asset. To understand what is urban area, what is rural area, we moved on to that definition of the criteria given to identify what is urban area. So any area in which there is a municipal corporation and the population is greater than 10,000 persons, in that case that area will be called as urban area. So very important point, if the area is regulated by municipal corporation and the population is more than 10,000, then it is an urban area. Next we understood that if the population is more than 10,000 but it is less than equal to 1 lakh, in that case everything within the jurisdiction of municipal corporation is urban area. Besides that, anything which is outside the jurisdiction of municipal corporation will also be considered as urban area if it is within the range of 2 kilometers. So anything in the range of 2 kilometers radius will be considered as urban area, and this 2 kilometers is required to be measured aerially. It is not a walking distance, it is a crow-flying distance or aerial measurement. Then we moved on to next point saying that if the population is more than 1 lakh but less than equal to 10 lakh, in that case anything which is within the jurisdiction of municipal corporation is a urban area, and anything which is within the range of 6 kilometers outside the radius of municipal corporation will also be considered as urban area. Lastly, we understood that if the population of the municipal corporation of the jurisdiction of municipal corporation is greater than 1 lakh, greater than 10 lakh, then anything which is within the jurisdiction of municipal corporation is urban area, but outside also within the range of 8 kilometers radius, everything would be considered as urban area. So we tried to understand this, and I also told you that this same points are also covered in the chapter of agriculture income. In section 2 clause 1 is subclause C. which talks about income from farm building. Income from farm building is exempt from tax provided four conditions are fulfilled. So in that fourth condition, you have the same agricultural land definition. So this was third point, point C, and then we moved on to point D. That is gold deposit bond, gold bond, special bearer bond. These things are not considered as capital asset. So yesterday I think this much we had completed. So what all things are not capital asset is defined. So these things we completed yesterday. Now we'll continue from here. See, definition of capital asset is given in section 2 clause 14. Section 2 clause 14 says capital asset excludes following. So what is excluded from the definition of capital asset is clearly given. In other words, definition is an exclusive definition. What is excluded is given. Besides that, whatever doesn't form part of exclusion will automatically form part of inclusion. So just for our understanding, I have written here that the capital asset can be tangible also, it can be intangible also. So goodwill is also a capital asset, land and building is also a capital asset. It can be movable also, it can be immovable also, or capital asset can be a business asset also, it can be a personal asset also. See, income from capital gain. When we say income from capital gain, this capital gain based on nature is divided into two categories, long-term capital gain and short-term capital gain. Capital gain based on nature, it is divided into how many categories? Two categories, long-term capital gain and short-term capital gain. This capital gain we can say it is of two categories, number one long-term capital gain and number two short-term capital gain. What do you mean by long-term capital gain? Long-term capital gain is defined as any gain which is on transfer of long-term capital asset, and short-term capital gain is defined as any gain which is on transfer of short-term capital asset. So whatever is gain on transfer of long-term asset will be considered as long-term gain, and whatever is gain on transfer of short-term asset is considered as short-term gain. Now the question arises, what do you mean by long-term asset? How do we decide whether a particular asset is long-term asset or whether particular asset is short-term asset? That is what we need to decide. See, whether a particular asset will be considered as a long-term asset or it will be considered as a short-term asset, it all depends upon the term of an asset, long-term capital asset and short-term capital asset. So based on this term means period, based on this period we will decide whether the capital asset is long-term capital asset or short-term capital asset. Term means the period for which you are holding the capital asset, the period for which you are holding the capital asset. Do we have Manoj today in the lecture? Yes. So we are trying to understand how to identify whether a particular capital asset is a long-term capital asset or short-term capital asset. I told you that it all depends upon the term of an capital asset. Term means for how much period, how much time you are holding that capital asset. For example, Manoj is having an affair with some girl. So in 11th standard he had an affair with some other girl. 12th standard he was having an affair with some other girl. F5 becomes some other girl. So it is a short-term relation or a long-term relation? Which type of relation it is? If his girlfriend changes every year, it is which type of relation? Short-term relation or long-term relation? Yes, definitely short-term. How did you decide that? Yes, because it is changing every year. Now say for example, Manoj completed his chartered accountancy and he got married to his girlfriend only. Then what? Then it is a long-term relation. So how do you decide whether the relationship is a long-term or short-term? It all depends upon the term, tenure. If the term is shorter duration of time, If the term is shorter duration of time, then we say it is short-term relation. If the tenure is very long, then we say it is a long-term relation. Similarly, here also, to decide whether a capital asset is long-term capital asset or short-term capital asset, we have to look at the term of a capital asset. Term means the period for which you are holding the capital asset. So, that period for which you are holding the capital asset will start from the date of acquisition. Date of acquisition means the date on which you have acquired the asset, and that term will end one day prior to the date of transfer. See, the term for which you are alive, the period for which you are here on this earth, that is called as life. So life is nothing but term starting from the date of birth and ending on date of death. So God has given you some term saying that you have to stay on this earth for say 40 years. So from your date of birth to date of death, that is a term. That is called as life. So there we take from date of birth to date of death. But here we don't take from date of acquisition to date of sale, or from date of purchase to date of sale. We take from date of purchase up to one day prior to date of sale. Up to one day prior to date of sale. For example, if you have purchased some asset, if you have purchased some capital asset on, say for example, date of purchase I am giving you as 1st April 2017, and date of sale of an asset is given to as 30th June 2020. Then this term of a capital asset will start from 1st April 17, but it will not end on 30th June. It will end on one day prior to this date. It will end on one day prior to this date, that is 29th June 2020. This period will be called as a period of holding. It will be called as what? It will be called as period of holding. Period of holding, it is very simple. In simple language, the period for which you are holding that capital asset, that will be called as period of holding. Now, based on that period of holding, we need to decide whether the capital asset is long-term capital asset or short-term capital asset. Yes, have you understood this period of holding concept? Have you understood? How do we decide whether the asset is long-term capital asset or short-term capital asset? Based on the period of holding. Period of holding means the tenure, term, length for which you are holding that capital asset. Now, for the better understanding of the provisions with respect to determination of asset, determination of whether the asset is long-term capital asset or short-term capital asset, we have divided the capital asset into three different categories. We have divided the capital asset into three different categories. Category 1, 2 and 3. All those assets which are capital assets, they are divided into three categories. Category 1, Category 2 or Category 3. Why we have classified the capital asset into three categories now? To determine whether it is a long-term capital asset or short-term capital asset. Our objective is to determine whether that capital asset is long-term capital asset or short-term capital asset. Now, a natural question may come to your mind saying that why we need to decide? Why short-term capital asset? Why long-term capital asset? Why to segregate? Because gain on transfer of long-term asset is long-term gain, and gain on transfer of short-term asset is short-term gain. But that is okay. Why we need to segregate? Whether it is short-term or long-term, what difference does it make? It makes a difference because the tax rates are different. Long-term capital gain is taxable at a separate rate, whereas short-term capital gain is taxable at separate rate. Let me tell you that long-term capital gain is taxable as per section 112. It is taxable as per section 112 and it is taxable as per section 112A. So 112, as per section 112, long-term capital gain will be taxable at flat rate of 20%. For the timing, you can forget about section 112A. You just think about section 112, then we can say that your long-term capital gain is taxable at flat rate of 20%, whereas your short-term capital gain is taxable at normal rates. What do you mean by normal rates? In case of individual HUF, AOP, BOI, artificial juridical persons, lab rates. In case of company, firm, etc., flat rate of 30%. So the tax rates are different. Tax rates are different. That is the reason we need to identify whether the gain is long-term gain or short-term gain. And that is the reason we need to identify whether the asset is long-term asset or short-term asset. So determining whether a capital asset is long-term or short-term is of utmost importance, because tax liability will be determined based on this. So capital asset we are dividing into how many categories? 3 categories. Category 1, category 2 and category 3. See, category 1 and 2 are exhaustive. In category 1 you are having 4 points, in category 2 you are having only 2 points. Rest all capital assets which neither fall into category 1 nor they fall into category 2, they will automatically fall into category 3. They will automatically fall into category 3. So first of all, let us try to understand what all things are included in category 1 and what all things are included in category 2. Number 1, in category 1, number 1 point says listed securities. It says what? Listed securities. Now, what do you mean by listed securities? Listed means they can be purchased or sold through stock exchange. So basically they are listed on stock exchange. And what do you mean by securities? The word security is much wider in scope. It will include shares, it will include debentures, it will include bonds, it will include government securities. All things are included in the word securities. But those securities will fall into category 1 only if they are listed on any stock exchange in India. They should be listed. If they are unlisted, then they can't fall into category 1. If they are unlisted, then they can't fall into category 1. So category 1 will include point number 1, listed securities. Listed securities means those which are listed on a stock exchange. You can sell through stock exchange, you can purchase through stock exchange. Number 2 is units of UTI. Do you understand units? Do you understand what is the meaning of term units? Yes? What do you mean by units? Do you understand units? Yes or no? Say for example, I am an investor. If I want to invest my money for capital appreciation, I can invest money directly into companies. But if I invest money in company and something goes wrong with that company will vanish from the market and my investment will turn out to be zero. So before investing my money, I should take an informed decision. Informed decision means company is into which business, who is managing the company, what are the plans of the company. All those things should be taken into account for the purpose of making a good investment decision. But as an individual investor, can I have a chance to take an informed decision? At least not in India, because a lot of information are not shared. I do not know what is going on within the company. Management is not going to share their future plans with me if I am a very small investor. So what I will do, instead of taking huge risk, I as an investor will give my funds to mutual fund. I will give my funds to mutual funds. So I have provided my funds to mutual funds. Now mutual funds would hire qualified people like chartered accountant or MBA in finance, etc. And there might be lakhs of investors who might have given their funds to mutual fund. So mutual fund will be having huge amount of money, say 5,000 crores, 10,000 crores. And definitely every company would like to ensure that mutual fund is investing in their company. So management would be ready to share their future plans with the mutual funds. So mutual fund managers may go to the company, they may take the interview of CMD, etc., so that they can come to know about some future plans of the company, in which direction company is going on. Plus they can pick up the financial of the company, they can study the financials. So whatever decision is taken by the mutual fund would be an informed decision, will be an informed decision. So mutual fund is now investing money in shares of the company. I have given my funds to mutual funds and mutual fund is investing money into shares. So, mutual fund has given money to company. It is not given money to company, it has acquired the shares. So, mutual fund has done the investment. Investment for what? Investment for acquiring shares. What is share? Share is one unit of capital in the company. In Companies Act, it is defined as share is a share in the share capital of a company. So, share is nothing but one unit of capital in the share capital of a company. Similarly, what is units? Units is nothing but one unit of fund in the entire funds of mutual fund. Say for example, total fund of mutual fund is 5,000 crores. That 5,000 crores is called as AUM. That is called as AUM. That is called as assets under management. Now those 5,000 crores, the way shares are having face value, units will also have a face value. That 5,000 crores is divided into 500 crores, 500 crore units of 10 each. So that unit is what? That unit is nothing but one unit of capital invested in the mutual fund. So now, here the investor is not directly investing into the company because there is huge risk. He cannot he don't have the information to take the concrete decision. So this investor will hand over his money to mutual fund. Mutual fund in turn will take an informed decision, will go through the financial of the company, will study the industry, what is the growth rate of industry, what is the growth rate of that particular company. All these things will be studied and then investment will be done. So there are less chances of capital loss. Capital will not be lost. There are very less chances of capital loss when you give your funds to the mutual fund. When you provide the funds to the mutual fund, in turn what do you receive? You receive units. You receive units. So an investor in a mutual fund is going to receive the units of mutual fund, whereas the investor in company is going to receive the shares in the company. So here in category 1 capital said, we are saying that second point is units of UTI. UTI stands for Unit Trust of India. You might not have heard about this name, but it was a mutual fund set up by the government of India. So, as of now it did not exist, but those people who had acquired the units, their units will fall into category 1. So, units of UTI. UTI is one of the mutual fund. So, units of UTI will fall into category 1 irrespective of whether they are listed or unlisted. Irrespective of whether they are listed or unlisted. Definitely, there might be some unlisted units also. But generally there won't be unlisted because nowadays, if you want to issue units, then it is mandatory to get them listed. It is mandatory to get them listed. That is as per the SEBI guidelines. So, but here, yes, listed, unlisted, what is not written. So, even if it is unlisted, it will fall into category 1 only. Even if it is unlisted, it will fall into category 1 only. So, category 1 capital asset includes number 1, listed securities. Number 2, it includes units of UTI. It includes units of a special mutual fund called as Unit Trust of India. Third point, it includes units of equity oriented fund. It includes what? Units of equity oriented fund. Do you understand equity oriented fund? Yes? Units of equity oriented fund. Do you understand what is equity oriented fund? No. Say for example, Manoj got married. And in a year's time he is having his first kid. The moment you come to know about this good news, all his friends will go to the hospital to see his child. So the moment you see him, the moment you see Manoj's first child, The general reactions in India is what? He is looking exactly like Manoj only. His face is like Manoj, skin color is like Manoj, or maybe he is looking like Manoj's wife. If, say for example, Manoj's first child is exactly looking like Manoj, then also his wife will be also having a contribution in that child. But physical features are same as Manoj. So we can say that it is a Manoj oriented child. Means more features, he has received more features from father. So father oriented child. Or more features he has received from mother. In that case, we say that it is mother oriented child. So similar to that, if I ask you what is units of equity oriented fund, then what? What is the meaning? It is having more features of equity. It is having more features of equity means investor has given funds to the mutual fund, and in turn mutual fund is investing money in the shares of the company. It is investing money in shares of the company. In that case, the investor which has invested into the funds of mutual fund, his units will be called as units of equity oriented mutual fund. If mutual fund, say for example, mutual fund is having a fund of 1000 crores, mutual fund is having a funds of 1000 crores. If mutual fund is investing at least 65% funds out of the total funds into equity shares, then the units will be called as units of equity oriented fund. Units will be called as what? Units of equity oriented fund. Have you understood this? So if investor is investing money in mutual fund, in turn mutual fund is investing money in equity shares, then the units will be called as units of equity oriented fund. In equity oriented fund, your returns will not remain the same, it will fluctuate, because mutual fund has invested money in shares, so return on shares is also fluctuating. Company may pay dividend, company may not pay dividend. Based on that, you will receive income from the mutual fund. So whatever dividend mutual fund is receiving from the company, that out of that dividend, some portion will be given to the investor. So investor will have a fluctuating return, because the nature of investment itself is equity oriented. On the other hand, we can also have something called as units of debt oriented mutual fund. We can also have something called as units of debt oriented mutual fund. Means I have invested my money in mutual funds. Mutual fund in turn has invested money in debentures of any other company or government securities or bonds. Mutual fund has invested money in bonds, government securities, debentures, etc. In that case, my units will be called as units of debt oriented mutual fund. My units will be called as units of debt oriented mutual fund. Now, very important point to be noted is units of equity oriented mutual fund will fall into category 1. They are covered by point number 3. But if the units are of debt oriented fund, then they will not fall into category 1. They will fall into category 3. So units of equity oriented fund, they are covered in category 1, whereas units of debt oriented fund, they are covered in category 3. Besides that, listen to me very carefully, I am giving you a very important point. Units of UTI will always fall into first category, irrespective of whether they are equity oriented or whether they are debt oriented. Units of UTI is always first category, irrespective of whether they are equity oriented or debt oriented. Units of other mutual funds, like you have Reliance Mutual Fund. Reliance Mutual Fund is now taken over by Nippo Mutual Fund. Nippo is a Japanese company. It had a tie-up with Anil Ambani Group. Now Nippo has taken over the major control over the company. So it is Reliance Nippo Mutual Fund, NIPPON. We have Birla Sun Life Mutual Fund. We have SBI Mutual Fund. You go on naming it, it is In India, you have hundreds of mutual fund and thousands of schemes of mutual fund. So, all those mutual funds, if they are equity oriented units of mutual fund, they will fall into category 3. If they are debt oriented units of mutual fund, they will fall into category. Equity oriented will fall into category 1, debt oriented will fall into category 3. But if they are units of UTI, only one mutual fund, UTI, Unit Trust of India, then it will fall into category 1, irrespective of whether they are equity oriented or whether they are debt oriented. Yes, have you understood this very clearly? Yes. So let's move on to the last point of category 1, that is zero coupon bonds. I don't think that I need to explain you zero coupon bonds now. In the chapter of PGBP, I have already explained zero coupon bonds. If you recollect, the rate of interest will be 0%. We also solved one question with respect to discount on issue of zero coupon bonds. So those zero coupon bonds will fall into category 1. So what all assets are included in category 1? Number 1, listed securities. So you have to remember this. Category 1 and 2 you have to remember. Listed securities, units of UTI, units of equity oriented fund and units and zero coupon bond. That will fall into category 1. Category 2 will include unlisted shares. If the shares are listed, it will go into category 1. If shares are unlisted, it will fall into category 2. Shares of private company are always unlisted. And even in certain cases, shares of public company can also be unlisted. You might have heard something called as closely held public company. Closely held public company means it is having only few investors. So, those shares can be unlisted. So, unlisted shares will fall into category 2, listed shares will fall into category 1. Is that very, very clear? Yes? So, unlisted shares will fall into which category? It will fall into category 2. Category 2. Okay. Let me ask you a question. It is open book examination. Let me ask you a very simple question. Listed debentures will fall into which category? Listed debentures, listed bonds. Yes. Where it will fall? Which category? Category 1. Category 1. Yes. What about the unlisted debentures, unlisted bonds? Unlisted debentures, unlisted bonds. They will fall into which category? They will fall into third category. Yes. Unlisted bonds, unlisted debentures, they will fall into third category. But in case of shares, it is not like that. In case of shares, if they are listed, they will fall into first category. If they are unlisted, they will fall into second category. They will not fall into third category. They will fall into second category. Second point is land and building. Either only land or only building or land and building both. It will fall into second category. Just 3-4 years back, it was falling into the third category. In fact, just 3-4 years back, we did not have 3 categories. We had only 2 categories. 4 years back, we had only 2 categories. Now, government has inserted one more category. Government has categorized unlisted shares and land and building into a separate category. Earlier, land and building was second category. Unlisted shares was second category. Category 3 did not exist. There were only 2 categories, but now there are 3 categories. So in second categories, we are having unlisted shares and we are having land building. Rest all capital assets will fall into third category. So can you give me some examples of those capital assets which will fall into third category? Can you imagine which assets will fall into third category? I have already told you 1-2 assets. Unlisted debentures, unlisted bonds. What else you can think of? What else will be covered by third category? Yes. Plant, machinery, furniture. Yes, what else? You can think of at least 5-6 points. Plant, machinery, furniture. Agreed. Besides plant, machinery, superb. So we have received the answer. We have received the answer from Deva. If you recollect this note number 2 specified movable asset, jewelry, archaeological collection, drawing, painting, sculpture, work of art, all these are capital assets. All these are capital assets. They will fall into which category? They will fall into third category. They will fall into third category. Yes or no? Yes. So now we have clearly understood what all will fall into first category, what all will fall into second category, and what all things will fall into third category. So now let's want to clearly understand when can we say that a capital asset is a long-term asset or short-term asset. Long-term asset or short-term asset. If the capital asset belongs to first category, then the period of holding applicable is 12 months. Period of holding applicable is 12 months, meaning thereby if you are holding that capital asset for less than or equal to 12 months, if you are holding that capital asset for less than or equal to 12 months, then that capital asset will be called as short-term asset. And the gain on sale of such asset will be short-term gain. Whereas if you are holding that capital asset for more than 12 months, it will be called as long-term asset and the gain will be long-term gain. Yes, Dikshit, tell me what is doubt? First category, period of holding less than equal to 12 months, it is short-term asset, gain will be short-term gain. Period of holding is more than 12 months, asset will be long-term asset, gain will be long-term gain. Dikshit, you can drop me the message. Agricultural land covered in 2 or 3? Yes? Tell me. Dikshit has asked the question. Agricultural land is covered by which category? Yes, definitely. It is covered by second category. So agricultural land outside India or in India in urban area is covered by second category. And agricultural land in rural area? Agricultural land in rural area is covered by which category? It is not covered anywhere. It is not a capital asset. So agricultural land outside India or in India in an urban area will be covered by second category, whereas agricultural land in India in a rural area is not a capital asset, it is not covered anywhere. In other words, if you sell the agricultural land in rural area, the gain is not taxable, loss cannot be claimed as set off. Yes, Dikshit, shall we move? So let's move on to second category. Now first category, have you understood now? How to identify whether a particular capital asset is short-term asset or long-term asset? Is that very, very clear? Yes. So now quickly we'll go through category 2 and 3. Category 2, period of holding applicable is 24 months. If the actual period of holding for that capital asset is less than equal to 24 months, then it is short-term asset, gain would be short-term gain. If the actual period of holding is more than 24 months, it is long-term asset, gain would be long-term gain. Lastly, category 3, check the period of holding. Period of holding applicable is 36 months. So if the actual period of holding for that capital asset is less than equal to 36 months, then it is short-term asset, gain would be short-term gain. And if the actual period of holding is more than 36 months, it is long-term asset and the gain would be long-term gain. So here I have completed the definition of capital asset which is given in section 2 clause 14. Now you can still ask me the question. Rizwan has asked the question, units of preference oriented fund. Rizwan, there is nothing called as units of preference oriented fund because preference shares are not issued to the general public. Preference shares are not issued to the general public. Generally, only private company will issue the preference shares, and preference shares are issued either to close friends and relatives. They are issued to people who are close ones, near and dear ones of the promoters, etc. So preferences are never listed, and we don't have anything called as preference oriented fund. It is only units of equity oriented fund. So investment into preferences is not open for the general public. So it is even not open for the mutual fund. It is not open for the mutual fund also. So there is nothing called as units of preference oriented fund. It is always units of equity oriented fund or units of debt oriented fund. Yes, have you clearly understood what is capital asset, what is not capital asset, which category it belongs to, how to decide whether it is long term asset or short term asset? Now I'll ask you a question. I'll ask you a very simple question. Yesterday I think I asked you a question. I do not remember. Let me ask you a question. This question was asked by ICAI in the examination for 5 marks. This question was asked by ICAI in the examination for 5 marks. Listen to me very carefully. Question said, see, capital asset, once you have decided that asset is a capital asset, you decide whether it is long term asset or short term asset. Once you decide whether it is long term asset or short term asset, then you proceed with respect to calculation of capital gain. As to how to calculate capital gain. Capital gain calculation is very simple. It is as good as you might have learned that formula in your school days, na? Cost plus profit equals to sales. Cost plus profit equals to sales. So if I want a formula for profit, what it will be? Profit equals to what minus what? Profit equals to selling price minus the cost price. This is the same manner in which we need to calculate capital gain. That's all. Capital gain calculation is not at all complicated. Very small format for computation of capital gain. It is just selling price minus the cost price. That's all. So without teaching you how to calculate capital gain, I am sharing with you the question which was asked by ICAI in the examination for 5 marks, and they fooled more than 80% of the students. In that question, they fooled more than 80% of the students. I am telling you at least 80%. I am giving you a question. It is an open book examination for you. Refer wherever you want to and give me the answer. Question says Mr. X is owning 2 motor cars. Mr. X is owning 2 motor cars, motor car A and motor car B. Motor car A was acquired for 2 lakhs, motor car B was acquired for 3 lakhs. After using for 4 years, motor car A is sold for 4 lakhs and motor car B is sold for 6 lakhs. Calculate capital gain if any. I am repeating, Mr. X is owning 2 motor cars, motor car A and motor car B. Motor car A was acquired at a cost of 2 lakhs, whereas motor car B was acquired at a cost of 3 lakhs. These motor cars are used by him for 4 years. Thereafter, motor car A is sold for 4 lakhs and motor car B is sold for 6 lakhs. Calculate capital gain if any. Yes? What should be the answer? So the correct answer is these motor cars, if they are used for personal purpose, they are not considered as capital asset, they are in personal effect. So they are excluded from the definition of capital asset. Therefore, there is no question of computation of capital gain. This was just two line answer. 5 marks were allotted to this question. 5 marks. Two line answer. 5 marks were allotted by CA Institute. 80% of the students went on for the calculation of capital gain. They calculated the amount of capital gain. So I am warning you, before you start a solution for any practical question, you have to refer to this flow chart. Let it take 1 more minute time. Let that 1 minute get wasted. You may think it is a waste, but it can prove to be a very big investment. So you decide first of all whether that asset is a capital asset or it is not a capital asset. If at all it is a capital asset, decide it belongs to category 1, 2 or 3. Don't directly Don't you dare to directly jump to categories. First of all, decide whether it is a capital asset or it is not a capital asset. Otherwise, examiner can fool you once again. Yes, have you understood this? But motor car used for business purpose, is it a capital asset? Motor car used in business, is that a capital asset? Yes, yes, definitely yes. Because it is forming part of block of asset. It is forming part of block of asset. And you know that in case of block of asset, you claim depreciation. And you have also discussed how to calculate capital gain in such case. In the PGP chapter itself, if you recollect, section 32 versus section 50, example number 1. So there we have already discussed whenever you have a depreciable asset, under what circumstance, under what situation, capital gain or capital loss will arise. If your closing WDV turns out to be negative, or when you have sold all the assets in the block, you will have short-term gain or short-term loss. That we have already discussed. So assets which are used for personal purpose, those movable personal effects are excluded from the definition of capital asset, but those same capital assets, those same assets, if they are used for business purpose and depreciation deduction is claimed on it, then yes, they are considered as capital asset. They would definitely belong to category 3. They will belong to category 3. So friends, with this we have completed the first condition entirely. What is the first condition of section 45 subsection 1? There must be a capital asset. So where the word capital asset is defined in section 2 clause 14, that is over. Third condition, capital asset should be sold, it should be transferred during previous year 2021, that is already over. Fourth condition, that capital gain should not be exempt, that is also over. So now we are left with second condition. What second condition says? There must be a transfer of capital asset. There must be a transfer of capital asset. For example, in this transfer definition, the word transfer is defined in section 2 clause 47. The word transfer is defined in section 2 clause 47. In this definition, I will make you understand point number 1, point number 2 and point number 7 right now. Point number 5 and 6 you take it as homework. Point number 5 and 6 you take this as homework. You read it once at home and then we will discuss. Even if you read it right now, you will come to know that this point number 4 and 5 you have already studied earlier. I am telling you where did you study. This was covered by section 27 house property chapter. This was also covered by section 27 house property chapter. So both point number 5 and point number 6 were already covered by section 27 deemed ownership in house property chapter. So you have to read it once. What I will be discussing in the class is why the same points are inserted here also. Why there is a need to insert the same point here also? Because they are already inserted in section 27. That reason I would be discussing. I will not discuss point number 5 or 6 in detail with you, because it is already discussed in detail. Definitely I will open that point number 5 and 6 in the chapter of income from house property. These points were taught to you from handwritten notes. So I would definitely open that handwritten notes in front of you and make you understand as to why point number 5 and 6 are also inserted here in the chapter of capital gain. So as of now, point number 5 and 6 are given to you as homework. Point number 3 and 4 will be covered in this chapter only, but it will be covered at a later stage, along with section 45 subsection 2 and section 45 subsection 5. So we will cover this with the appropriate topic. So right now we will just refer to point number 1, 2 and 7. Right now we will just refer to point number 1, 2 and 7. Now listen to me very carefully. Section 45 subsection 1 doesn't say that capital gain is gain on sale of capital asset. It uses the word capital gain is gain on transfer of capital asset. So what is the difference between the word sale and transfer? Word transfer is much wider in scope as compared to the word sale. The word transfer includes sale. The word transfer includes sale. Let me give you an example. Say, think about a situation. What would happen if instead of using the word transfer, government would have used the word sale in the charging section 45 subsection 1. If government would have said that capital gain is gain on sale of capital asset, then what would have happened? See, what do you mean by sale? Sale means there are two parties to the transactions, seller and buyer. Seller would transfer the ownership and possession to the buyer, and buyer would pay the consideration. This is a normal sale transaction. But for example, if government would have used the word sale in section 45 subsection 1, then it would have a deadly consequence. Most of the transactions government would not get capital gain tax. For example, I am having 2 kg of gold. Whose market price is 1 crore rupees. And you are having 3 BHK flat in the city of Chennai. In the city of Chennai, somewhere you are having a 3 BHK flat. That flat is valued at 1 crore. So, what I'll do? I'll give you gold worth 1 crore and I'll take your flat. So, we both have exchanged. What we have done? I have exchanged my gold for flat and you have exchanged your flat for gold. Will there be any capital asset? Will there be any capital gain? Because if government would have used the word capital gain is gain on sale of capital asset, then people will say that I have not sold the capital asset. I have not sold my flat. I have exchanged my flat. So people will try to move out of the clutches of the government and they would easily evade the tax. Therefore, government is intentionally not using the word sale and government is using the word transfer. And government has defined the word transfer. So, government in section 2 clause 47 says, transfer in relation to capital asset includes following. See, very important point to be noted is, this transfer definition is given in section 2 clause 47. But this transfer definition, the word transfer, anywhere used in the Income Tax Act, this definition will not apply. This definition is applicable only to the chapter of capital gain. Because it clearly says, the word transfer in relation to capital asset. So if you move on to some other chapter, salary, PGEP, other, etc., there if you come across transfer word, you can't take this meaning. This meaning is restricted only when you are using the word transfer in context of capital asset. So transfer in relation to capital asset includes number 1, sale. Now what is sale? That I have already explained you. There are two parties, seller and buyer. Buyer would pay the consideration, seller would transfer the possession as well as ownership of the asset. This is called a sale. What do you mean by exchange? One capital asset is exchanged for another capital asset. The same example which I gave you just now. I have given 2 kg of gold to you and you have transferred your flat to me. That is nothing but exchange. One capital asset is exchanged for another capital asset. That is called as exchange. Then we have relinquishment of a capital asset. Relinquishment of a capital asset or extinguishment of rights in the capital asset. See, relinquishment and extinguishment, these words are different, meaning is different, but ultimately it doesn't make any difference. Whether it is relinquishment or whether it is extinguishment, ultimately it is considered as transfer. So yes, you have to calculate capital gain. But still I will try to explain you what is the difference between relinquishment and extinguishment. Say for example, Manoj was having an affair with one girl. And he had decided that I'll marry this girl only. So after he became chartered accountant, he married that girl. After marriage, just within a few months, they are fighting with each other. So Manoj's wife felt that now there is no love in our relationship. Love was only before marriage. Now there is no love. So that girl decided that staying together and fighting for entire life, instead of that, let us get apart. So that girl went to her parents' house and they appointed a lawyer and then they made a divorce agreement. And the copy was sent to Manoj saying that you please sign that copy and send it back to us. So some people are ready to accept the facts. They are ready to accept the reality. But some people are revengeful. Some people are revengeful. So Manoj, for example, is having a revengeful attitude. Only I have a right over that girl. How can she leave me? That is his attitude. So Manoj called up that girl saying that you come to meet me for the last time. Only once you come to meet me for the last time. Thereafter I'll never call you back. So somehow he convinced that girl saying that yes. So she told that where should I come? So Manoj said that do you remember where we met first time in our life? When I met you for the first time? When you met me for the first time? So that girl says no, I don't remember. So Manoj said we met in our building's terrace only. In my building's terrace, you had come to some friend's house. So you were in my building's terrace with your friends. There I saw you. How can you forget this? So Manoj has called her on a terrace. As usual, she has reached at the agreed time. Manoj has not reached. So that girl is looking outside the building from the terrace. She is looking down. And she is seeing whether Manoj is coming or not. Surprisingly, Manoj came from back and he has pushed that girl. So that girl has fallen from the terrace and lost her life. So who is having a right on that girl now? Life has ended. Manoj's right on that girl has ended. Everyone's right on that girl has ended. This is called as extinguishment. So extinguishment means what? Your asset do not exist. It is gone out of this world. So when your asset do not exist, your rights in that asset will automatically come to an end. Say for example, you are owning a building and the location at which you are having a building, there is an earthquake, and in that earthquake, that building has got demolished. So now that building asset do not exist. So your right in that building will automatically come to an end. That asset do not exist. That is called as extinguishment. When the asset do not exist, we call it as extinguishment. If asset do not exist, your right in that asset will automatically end because asset do not exist. There is something called as relinquishment. Relinquishment means asset is existing, but only your right in that asset has ended. For example, Manoj, the moment that girl went to her house and they sent the divorce papers, Manoj has signed the divorce papers, and while signing he has also put a smiley there saying that I wish you good luck for your life. So Manoj is having a attitude of accepting the facts, accepting the life as it comes to him. So now that girl has married to someone else. So Manoj's right has come to an end. Someone else's rights are established. This is called as relinquishment. In that, life of an asset has not come to an end. When you sell the asset to someone, your rights in that asset come to an end, someone else's rights will be established. So, in that case, we use the word relinquishment. We have a lot of examples of extinguishment, relinquishment, etc. Have you completed a chapter called as internal reconstruction in accountancy? Internal reconstruction, there is something called as surrender of shares. Do you remember surrender of shares? Surrender of shares means every shareholder, out of the total number of shares he is holding, some number of shares he has to surrender to the company free of cost. And after those shares are surrendered, those shares can be issued to someone else, or those shares can be cancelled. Those shares can be either issued to someone else, or those shares can be cancelled. If those shares are cancelled, then what? Then we say it is extinguishment of rights. If those shares are surrendered, but those shares are reissued to someone else, then your rights in that shares will come to an end. Someone else's right will be established. That will be called as relinquishment. So we have a lot of examples of relinquishment, extinguishment. Redemption of preference shares, redemption of debentures, redemption of bonds, redemption of zero coupon bonds, forfeiture of shares for non-payment of call money. All these are examples of extinguishment, relinquishment. So I have given all those examples only for your reference. No one is going to ask you in the examination. In the examination, is no one going to ask you what is the difference between relinquishment and extinguishment. It is just that for your better understanding, I am explaining all these things. So transfer includes number 1 sale, number 2 exchange, number 3 relinquishment, number 4 extinguishment. So with this we have covered point number 1 and point number 2. Point number 3 and 4 will be covering at a later stage. Point 5 and 6 are given to you as homework. Point number 7 is self-explanatory. What is point 7? Maturity or redemption of zero coupon bonds. Redemption means what? You will return the bond certificate back and you will get your money back. That is called as redemption. That redemption will be considered as transfer. So if you have invested money in zero coupon bonds, say for example bonds were issued at a huge discount to the face value. Same example of our business profession chapter question number 10. Bonds having a face value of 100 are issued at 40. So there is a discount of 60. But those bonds will be redeemed at what price? They will be redeemed at par, say at 100. So in the year of redemption, you will have to calculate capital gain. 100 would be considered as your redemption value. 40 would be considered as issue price. The difference of 60 will be taxable to investor under that capital gain. That 60, company will claim deduction under that PGBP considering it as discount on issue of zero coupon bonds. But for investor, that discount on zero coupon bonds will be taxable in the year of redemption. It will be taxable in the year of redemption. Yes, have you understood this? Yes? Okay. Only for your reference, I have given you the definition of zero coupon bond also. No one is going to ask you what is the definition of zero coupon bonds. Now friends, let's move on to first question of this chapter. Very small and simple question it is. I'll give you 2 minutes time. You have to refer to question number 1, point number 1, 2, 3 and 4, and you have to decide whether the asset given in the question, is it a capital asset or it is not a capital asset. If at all it is a capital asset, whether it is long term asset or short term asset. Take 2 minutes time and go through it and decide. What is point number 1? It says X purchases preferences in a foreign company on 20th January 2018. These preferences are transferred by him on 18 January 21. These shares are not listed on any recognized stock exchange in India. Preferences are generally not listed. Preferences of foreign company. Are they capital asset? Yes. Which category? Category 2. Category 2. So period of holding applicable is how much? 24 months. So 24 months will get over on which date? From 20th January 18. 24 months will get over on which date? Yes? 24 months will get completed on, yes, correct. 24 months will get completed on 19th January 20. 19th January 20. And you have transferred the shares on 18th January 21. So definitely it is a period of more than 24 months. So this is a long-term capital asset. This is a long-term capital asset. Yes? Is that very, very clear, all of you? So definitely the gain has to be long-term gain. But in this question, they are not asking us to calculate the gain. Cost is not given, selling price is not given. So it is not even possible for you to calculate. You have to just identify whether the asset is long-term or short-term, that's all. Point B. Why purchases debentures of a company on 10th March 18? Can you tell me these debentures will fall into which category? You can't tell. Because you should have an information as to whether these are listed or unlisted. If they are listed, they will fall into first category. If they are unlisted, they will fall into third category. These debentures are transferred on 5th January 21. Debentures are not listed on any recognized stock exchange in India. Debentures are not listed. They will fall into which category? Category 3. So the period of holding applicable is how much? 36 months. So from 10th March 2018, 36 months will get completed on which date? From 10th March 18, 1 year will be 9th March 19. 2 year will be 9th March 20 and 3 years would be 9th March 21. 9th March 21. But you have already transferred that debentures before that itself. So the actual period of holding is less than 36 months. So it is a short-term capital asset. It is a short-term capital asset. Yes, is that very, very clear? Everyone? Yes? Let's move on to the third point. This is the most important. In case 2 above. So you pick up the information from the second point itself. It says suppose the debentures are listed on a Cochin stock exchange with effect from 1st January 21. Now listen to me carefully. These debentures were acquired on which date? 10th March 18, because you have to take the information from second point only. These debentures were acquired on 10th March 18 and they are transferred on 5th January 21. Just 4 days before transfer, these debentures got listed. So, at the time of purchase of debentures, they were unlisted, but at the time of sale, they were listed. Unlisted debentures will fall into category 3, listed will fall into category 1. At the time of purchase, they were unlisted, at the time of sale, they were listed. So now the question arises, the question which should naturally come to your mind is, whether we should see whether the debentures are listed or not, whether we should see this on the date of purchase or whether we should see this on the date of sale. Listed or unlisted should be checked on which date? Should it be checked on the date of purchase or should it be checked on the date of sale? Have you understood the question? So, question is whether the debentures are listed or unlisted should be seen on which date? Should we see on date of purchase or date of sale? If you tell me that yes, you have to see on date of purchase, then these debentures are unlisted. Then it will fall into category 3. But if you decide that yes, listed or not should be seen on date of transfer, date of sale, then they are listed. Then they will fall into first category. My simple question to you is, capital gain is what? Capital gain is what? Is it gain on acquisition? Or it is gain on transfer? What it is? Capital gain is not gain on acquisition, it is gain on transfer. So on which date we should see whether the debentures are listed or unlisted? Definitely we should see on the date of transfer, not on the date of acquisition. So on the date of transfer, these were listed. So they will fall into which category? Category 1. And their actual period of holding is definitely more than a year. So these are which assets? Long-term cap assets. Long-term cap asset. Yes, is that very clear? Now let's move on to the last point. Point number 4 of question 1. Z purchases listed government securities on 6th March 19. Z purchases listed government securities on 6th March 19. This will fall into which category? Definitely category 1. These are transferred by Mrs. Z. Listed securities were acquired by Mr. Z, but those securities are transferred by Mrs. Z. These securities are transferred by Mrs. Z on 31st March 21. After the death of Z. So Z has died. Thereafter, this securities Mrs. Z has received by way of inheritance. So Z died on which date? 20th February 2021. Just after around one month, Mrs. Z has sold listed government securities. Now you tell me, Z had acquired these securities on which date? 6th March 19. 6th March 19. Z died on which date? 20th February 21. Z died on 20th February 2021. So can I say Z was holding these securities from 6th March 19 to 20th February 21? For this period, Mr. Z was holding the securities. Mrs. Z has sold the securities on 31st March 21. So Mrs. Z was holding the securities from 20th February 21 to 31st March 21. Now the question is, listed security falls into which category? Definitely the first category. So the period of holding applicable is 12 months. Now the question is, who is selling the securities? Dikshit, wait for 1 minute. I'll explain you, don't worry about that. Let us first cover this point number 4. Then I'll go back to point 3. Focus here, first of all. Let us complete this point. We can't leave it midway. So, my question to you is, these securities, you have to decide whether it is short term or long term. The applicable period of holding is how much? 12 months. Who is selling these securities? Mrs. Z is selling the securities. Yes or no? If you take up the period of holding of Mrs. Z, it is from February 21 to March 21. It is less than 12 months. So what you would say? It is short term asset. But the question is, should you only look at the period of holding of Mrs. Z? Or should you also look at the period of holding of Mr. Z? Should you combine both the period of holding? That is the question. Are you understanding what is the question? Whether the period of holding of Mrs. Z, should we include the period of holding of Mr. Z? So answer to this question is given in section 2 clause 42a. Section 2 clause 42a says, if you have received any asset by way of gift, by way of will, by way of inheritance, if I receive any asset by way of gift, will, inheritance, succession, devolution, or on partition, everything is written in the book, I'll show you, don't worry. Or on partition of HF. Or on partition of HF. Then, period of holding of SSE, Mrs. Z is SSE. And in this case, Mr. Z is called as previous owner. Mr. Z is called as what? Previous owner. So here we say that when you have received the capital asset by way of gift, will, inheritance, succession, devolution, or on partition of HF, in that case, period of holding of SSE should include the period of holding of previous owner. In other words, period of holding of Mr. Z should be included in the period of holding of Mrs. Z. Yes, have you understood this very clearly? Yes or no? So the date of death of Mr. Z, which is given the question, it becomes irrelevant. So to take the period of holding from 6th March 19 to 31st March 21. So there is definitely more than 12 months. So it is which asset? Long-term capital asset. Yes? Is that 100% clear? Now Dikshit was asking me, sir, what is devolution? Devolution means giving away. I can give you only one example. Dikshit, do you understand in Hindus, we have special temples. Say, one of that temple is located in Varanasi. The head of the temple, see in church we call it as priest, no? Priest. He is having a control over the property of the church. He is having a control over the property of the church. Similarly, that priest in, I don't think which country, do you know Pope? Which country, US or France? Pope belongs to which country? Anyway, forget about it. So I am just telling you that the property of church is managed by a person. That person will manage the entire church. He will also manage all the properties of the church. So that person is called as priest. That person is called as priest. Now that person will retire. Now someday he will retire because of age factors. So say for example that one particular priest has retired from the church and some other person has been appointed. So that person who was earlier handling the property of the church has to hand over that property to the new person, new priest. That is called as devolution. Property is devolving upon the new person. Yes. Okay. Now, you wanted me to go through point number 3. I am just going through point number 3. Dikshit, I will not refer to point number 3. I will make you understand. See, in point number 3, they are saying that refer to point number 2 itself. In point number 2, debentures are acquired on 10th March 18 and they are transferred on 5th January 21. At the time of purchase, those debentures were unlisted. At the time of sale, those debentures were listed. If the debentures are listed, they will fall into first category of capital asset. If they are unlisted, they will fall into third category of capital asset. Period of holding is different in category 1 and 3. So, if you look at these debentures, at the time of purchase they were unlisted, at the time of sale they were listed. So, my question was, whether the debentures are listed or unlisted should be seen on which date? should be seen on the date of purchase? Should we see on the date of sale so as to decide whether the asset is long term or short term? If you say that listed unlisted is required to be checked on the date of purchase, then you will say that these debentures were unlisted on the date of purchase, they will fall into category 3. But if you conclude that whether the debentures are listed or unlisted, that condition should be checked on the date of sale, then you will say that these debentures were listed on the date of sale, because on 1st January 21 they were listed now. So on 5th January when you sold they were listed. So in that case they will fall into first category. If they fall into first category, period of holding applicable is 12 months. Dikshit, are you getting the point? So what we concluded? We concluded that whether the debentures are listed or unlisted is not required to be seen on the date of purchase. It is required to be seen on which date? On the date of sale. So here on the date of sale they were listed. So period of holding applicable is 12 months. And here the period of holding is more than 12 months. So we concluded that it is a long-term asset. Long-term asset. Shall I proceed? Dikshit, is that very clear? Yes or no? Yes? It is rule or assumption? No, it is neither, it is not an assumption. Why there is a need to take an assumption? Because charging section says what? Capital gain is gain on transfer, na? You are not calculating capital gain in the year of acquisition. Are you calculating capital gain in the year of acquisition? If yes, you check the condition whether they are listed or unlisted on the date of acquisition. You are calculating capital gain in which year? You are calculating capital gain in the year of transfer. So it is implied. See, on which date we should issue a death certificate to a person? Should we issue a death certificate also on the date of birth? For example, there is a law which says that issue of death certificate is mandatory. Issue of death certificate is mandatory. If you want to complete the last rights of a person, issue of death certificate is mandatory. If government comes out with such law, then it is implied, na, death certificate will be issued on death, na? It will not be issued on birth. Similarly, here also it is implied. Capital gain is gain on transfer. So on the date of transfer only, you have to see whether it is listed or unlisted. Dikshit, yes or no? Okay, let's move on to page number 217 in your book. In your textbook, let's move on to page number 217. Here the solution is given to you for question number 1. Now let me tell you right away at the beginning, entire chapter of capital gain, na, format of the solution is given for each and every question. So whenever we solve, we'll be solving the question in this format only. So in this answer number 1, sorry. In this answer number 1, what we decided? Yes? Question 1.1. What we decided? The short-term asset or long-term asset? Period of holding applicable was how much? Question 1.1 given on page number 173. You have to look at page number 173 and 217 simultaneously. Question 1.1. Yes? We applied the period of holding of 24 months. But by mistake, wrongly, in the solution it is mentioned as 36 months. So we make the appropriate changes here. Period of holding is from 20th January 18 to 17th. 17, why they have taken 17 January? In the question they have given 18 January. Because period of holding is required to be taken up to 1 day prior to the date of transfer. It is required to be taken up to 1 day prior to the date of transfer. Correct? So here you should not apply the period of holding as 36 months. You should apply it as 24 months. Now it is more than 24 months or less than 24 months? Definitely it is more than 24 months. So change that sign also. Since the shares are unlisted, period of holding applied to be applied is 24 months. Since in this case period of holding is greater than 24 months, preference shares will be considered as long-term asset. Long-term asset. So this mistake we have rectified. Actually, all these things we discuss in the class. In the class, I just write on the board now. This time I had an intention of providing you solution, so I just picked up the solution. Old solution was taken. So we will once again move back to our original discussion. Page is 173. So question number 1 is over. Now we will move on to our discussion with respect to computation of short-term gain and long-term gain. Section 45 subsection 1 charging section is entirely over. Now we move on to section 48. Section 48 is the computation provision. It will help you to compute the amount of capital gain. So the format of computation of capital gain is given where? It is given in section 48. So here in front of you, you are having capital gain calculation. Format for the computation of short-term capital gain and format for the computation of long-term capital gain. The size of the solution will be this much only. But in this small table, there are a lot of provisions which are required to be applied. That we will learn over a period of time. So left hand side, let's first of all understand that format is very, very simple. I am taking an example for you. Mr. Om acquired a residential property for 5 lakh in 1011. Mr. Om acquired a residential property for 5 lakh rupees in 1011. Mr. Om constructed an additional floor on the residential house property acquired at a cost of 1 lakh. So 5 lakh cost he has incurred in financial year 1011 for purchasing the property. 1 lakh cost he has incurred during 1213 to construct a additional floor on the same property. So 5 lakh as well as 1 lakh both are capital expenditure. None of them is revenue expenditure, both are capital expenditure. Then further it says Mr. Om sold the residential property on 26 January 21. 26 January 21 falls into your previous year 2021. It falls into your previous year 2021 and 7 lakh 60 is the selling price of the property. He also incurred a brokerage of 10,000. He incurred a brokerage of 10,000. Now forget about capital gain. Forget about capital gain. If you are a school child, and if I give you these 4 numbers, and if I ask you to ascertain the amount of profit, how will you calculate? Selling price minus cost price. Simple. What you would take as selling price? 7 lakh 60. From that you will deduct everything. 5 lakh, 1 lakh, 10,000, everything. So what will be the amount of profit? 7 lakh 60 minus 5 lakhs minus 1 lakh minus 10,000. So you get a profit of 1 lakh 50. Yes, that 150 itself is a capital gain. No complexity at all. Simplest chapter in the entire 5 heads of income. Very simple. But when we introduce different sections and provision, you will realize that yes, it is not as simple as it appears. But yes, let me now use some terminologies which are known to you. 7 lakh 60 is called as gross selling price. 7 lakh 60 is called as what? It is called as gross selling price. Gross selling price means without deducting any expenses. Without deducting any selling expenses. Now I am using accounting terminologies. Gross selling price is the word which you might have heard in accounts. So here in our example, gross selling price is 7 lakh 60. What is the selling expenses? 10,000. Expenses incurred at the time of sale should be deducted from selling price. So I am deducting selling expenses 10,000. So I get an amount of 7 lakh 50. This is nothing but my net selling price. This is my net selling price. From that I should deduct my cost price. My cost price is nothing but the capital expenditure which I have incurred at the time of purchasing property 5 lakhs. At the time of constructing additional floor on the property 1 lakh. Once I deduct that, I arrive at the amount of profit which is 1 lakh 50. Format for computation of capital gain is as simple as this. So now let us look at the terminology which is used in income tax. In income tax, what terminologies are used? For the word gross selling price, we use the terminology full value of consideration. Full value of consideration. Full value of consideration is nothing but the price which SSE has acquired or price which he has received by transferring the capital asset, and that without deducting any expenses. That is called as full value of consideration. From that you deduct expenses on transfer. If you look at the format in the textbook, they are using the word expenses incurred wholly and exclusively in connection with transfer. You need not write such a long sentence in the examination. Even if you write the word expenses on transfer, that is sufficient, examiner will understand. So selling expenses we call it as expenses on transfer. Net selling price we call it as net consideration. Net selling price we call it as net consideration. Next is purchase price. Purchase price we term it as cost of acquisition. All the expenses which are incurred at the time of purchase will be added to the purchase price only, and the amount which is derived will be called as cost of acquisition. Once you have put an asset to use, thereafter if you have incurred some capital expenditure on it, that capital expenditure will be called as cost of improvement. Will be called as what? Cost of improvement. From net consideration, you deduct cost of acquisition, you also deduct cost of improvement. The amount which is derived is called as capital gain. It is just that they are using some different terminologies. The formula is nothing but selling price minus cost price is profit, that's all. That is the same formula they have used here. Now we'll go through the format for computation of short term gain. See, first point, full value of consideration. Number 2, expenses incurred wholly and exclusively in connection with transfer. Instead of writing this, you can write expenses on transfer. Then we have net consideration. From that you deduct cost of acquisition, cost of improvement. The amount which is arrived will be called as gross short term capital gain. Will be called as what? Gross short term capital gain. From this gross short term capital gain, you should deduct some exemption. If at all it is available, you deduct the exemption, and once you deduct the amount of exemption, the amount which is arrived is called as taxable short term capital gain. That amount will be called as what? Taxable short term capital gain. Have you understood this format? Yes or no? Yes? Okay. Now, few paragraphs I will give you as homework. You have to read at home. This full value of consideration. You have to read it once. You will understand. Expenses on transfer. Cost of acquisition. Next is cost of improvement. All these things you have to read it once. Now, left hand side we have the format for computation of short term gain. Right hand side we have the format for computation of long term gain. You just refer to that format for computation of long term gain on the right hand side and identify the difference. What is the difference in computation of short term gain and computation of long term gain? What is the difference? That format is same, no change. What is the difference? Yes, in case of long term gain, full value of consideration, expenses on transfer, net consideration, cost of acquisition, cost of improvement, capital gain, everything is same. What is the difference? Here instead of cost of acquisition, we are taking up indexed cost of acquisition. And instead of cost of improvement, we are taking up indexed cost of improvement. Yes? Once you deduct the index cost of acquisition, index cost of improvement, you arrive at the amount of gross long-term capital gain. From that, you deduct the exemption. If you compare the exemption, now short-term capital gain, we have only 4 sections relating to exemption. But long-term capital gain, we have more sections. Section 54, 54B, 54D, E, C, F, G, G, A, G, B. More number of sections for exempting long-term gain, less number of sections for exempting short-term gain. This is also the difference. Once you deduct the exemption, if any, if at all there is exemption, you deduct that amount and the amount which is arrived will be called as long-term gain. Yes? Have you understood the difference between short-term gain, long-term gain calculation? First point of distinction is index cost of acquisition. Second point of distinction is index cost of improvement. And third point of distinction is difference in sections relating to exemption. Now question may arise in your mind, what do you mean by this indexation? What is this indexation? See this, I took an example to make you understand how this capital gain will be required to be calculated. Now listen to me very carefully. I want to just ask you, in this example, Mr. Om acquired asset in which year? In the year 1011. He constructed additional floor in the year 1213. And he sold the property in which year? 2021. In the year 2021, he also incurred a brokerage. So in this format, if you see, the gross selling price, that is your full value of consideration, pertains to the year 2021. Yes or no? The amount of 7,60,000 pertains to which year? 2021. Expense on transfer also pertains to the year 2021. Net consideration is a derived amount that also pertains to the year 2021. But the cost of acquisition pertains to the year 1011. Whereas cost of improvement pertains to the year 1213. My question to you is, 5 lakh rupees in 1011 and 5 lakh rupees in 2021, do you believe they are same? 1 lakh rupees of 1213 and 1 lakh rupees of 2021, do you believe they are same? No. Why they are not same? Why they are not same? Because of inflation. Whatever you bought at 5 lakh rupees in the year 1011, you cannot purchase it as of now for same amount. You have to pay more. For everything you have to pay more. So, it is because of inflation. Now, my question to you is, the calculation which you did for computing this capital gain, do you believe this is correct? Are the amounts comparable to each other? One amount is pertaining to the year 1011, the other one is pertaining to 1213. All these you are comparing with the financial year 2021. This is non-comparable amounts. For example, you appeared for 10th standard examination. Your father had also appeared for 10th standard examination. Na? In his time, he had scored 85%. In his time, your father had scored 85% in 10th standard examination. You have scored 90% in your 10th standard examination. On the day of declaration of result, you went to your father and said, see, I have scored 5% more than you. Do you believe that your papers and his papers are comparable? If his ego gets hurt, he will tell you that in your generation people are scoring 98%. In some exceptional cases, they are also scoring more than 100%. Because of that sports quota, in Maharashtra, we came across few incidents wherein the percentage scored by the child was 99% and he got some 15 marks because of that sports quota. So his percentage went beyond 100. So your father will say that in your time, people are scoring more than 100. In my time, I was the topper of the state at 85%. In your time, you also do not fall into the top 100 in 90% also. So the examination of 10th standard taken in those olden days and taken right now, they are not comparable. If you want to compete with your father, then either you go and appear for that old examination, you take out the old examination paper which was taken 25 years back, or ask your father to appear for same examination right now. Then only things can become comparable. I cannot compare two things which are uncomparable. I cannot compare apple and mango. Similarly, I cannot compare the amounts of 10, 11, 12, 13 with 20, 21. They are not comparable. If I want to at all compare it, what should I do? I should make them comparable. How should I make them comparable? Either I should pick up the amount of 2021 and take it back to 1011 or 1213, or I should pick up the amount of 1011, 1213 and take it to 2021. In FM you had, FM subject is on capital budgeting chapter. Now you might have learned present value, future value. Yes or no? No. Harshit says no. Harshit, FM subject is over now. Oh, most of them are saying no. Why? FM subject is not over for all. Yes? November attempt. Oh, forget about it. CA foundation also you had something na? Discounting, compounding. Do you understand? Forget about future value, present value. In mathematics, you might have learned something called as time value of money na? Foundation. Have you learned something called as discounting, compounding? Yes or no? Yes. So now listen to me. These amounts of 2021, they are not comparable to 10, 11, 12, 13. To make it comparable, what you can do? You can pick up the amounts of 2021, apply the formula of discounting on it and take it to 10, 11. In that case, values of financial year 2021 will reduce. Or see, let me give a very simple example first of all. Say for example, you are having a smartphone. But your father is having an old phone, that is a keypad phone. Do you understand na? Keypad phone, old phone, keypad phone. You have the buttons na yaar, for alphabets. Right now also those phones are available only at 1000 rupees, 1500 rupees. Now say for example, you are having a smartphone, whereas your father is having a keypad phone. And you are asking your father, oh, let us have a competition. I will try to search number from my address book and you try to search number from your address book. Let's see who searches fast. Do you believe that this competition is comparable? No, because your phone is faster than him. Your phone is having 4 GB RAM. It is as good as a laptop only. His phone, you have to type every alphabet. So he'll find out the contact number from your address list in a span of say 10 seconds time. He will take 30 seconds. If you want to make it comparable, what can we do? we can take away your smartphone and we can give a keypad phone to you also. Or other option is ask your father to upgrade his phone. Ask him to throw that keypad phone and ask him to purchase smartphone for him also. In that case, the situation will be comparable. Now what should we do? Should we take away your phone and we should give you a keypad phone to you? Or should we ask your father to upgrade his phone? What should be done logically? Definitely, we should try to upgrade the mobile phone of your father, na? Similarly, here also, to make the amounts comparable, we have two options. Option 1, take the values of financial year 2021, apply the concept of discounting and take those amounts to 1011 so that they will become comparable. Or option 2, pick up the amounts of 1011 and 1213, apply the concept of compounding, and take those numbers to 2021. Once these numbers of 1011 and 1213, if you apply the concept of compounding here on these amounts, what will happen? Apply the concept of compounding on this amount of 10, 11 and 12, 13. You take those numbers to 2021. What will happen? Those amounts will become comparable. Once they are comparable, then you can deduct those amounts. Are you understanding? Yes? Have you understood the logic behind indexation? Because of inflation, you cannot buy the same commodity or same asset at same price after 10 years. Therefore, government says, in case of computation of long-term gain, we are going to give you some benefit, and that benefit is called as indexation benefit. Due to inflation, the cost of an asset will increase. So on that cost of acquisition and cost of improvement, you apply the index numbers. You apply the indexation. You give the effect of inflation on that. By giving the effect of inflation, your value for the cost of acquisition and cost of improvement will increase. Yes? Have you understood? Yes or no? Yes. Now the question is how to apply that indexation or how to do the compounding, etc. So compounding will be done taking into account the numbers which government has given. Compounding will be done taking into account the index numbers which are issued by the government. So on page number 175 in your book, you are having the index numbers. These index numbers you need not remember, this will be given to you in the examination. Year-wise index number is given to you. Plus, these index numbers would remain the same for the entire year. For example, index number for the year 1-2 is 100 and index number for the year 2-3 is 105. Now, for example, you want to find out the index number for 30th September 2002. You can't say that there is a difference of 5. So 5 is for the entire year. For 6 months it is 2.5. So if it is 30th September 2002, it is 102.5. You cannot find out a new index number. Index number will remain constant throughout the year. You don't have to apply mind beyond a particular point. Whatever is given, based on that index number, you do the calculation. Now my question is, first of all, are you all having calculator with you? Yes or no? Do you have calculators? Yes, very good. So, question is how to do the indexing for this. How to do the indexing? Cost of acquisition belongs to which year? 10-11. What is the cost? 5 lakhs. I need to apply the index numbers and do the indexing. What should I do? I should take up my cost, which is 5 lakh. And the two relevant index numbers will be of which year? One will be of financial year 10-11. The other one would be of financial year 2021. So what is the index number of 10-11? 167. Yes or no? And what is the index number of 2021? 301. So these are the two index numbers which are relevant for doing the indexation for your cost of acquisition. Now which one should be taken as numerator index, which one should be taken as denominator index? 5 lakh is the value pertaining to the year 1011. I need to find out the corresponding value of 2021. So 5 lakh into something divided by something. What should become my numerator? Definitely 301 should become my numerator. 167 should become my denominator. So apply the indexation and get me the amount. 5 lakh into 301 divided by 167 is 9 lakh 1198. This 9 lakh 1198 is called as indexed cost of acquisition. This is called as what? Indexed cost of acquisition. So this same table once again I have reproduced here. This time I am doing the real calculation, more logical calculation. 7 lakh 60 is my full value of consideration. 10,000 is my expenses on transfer. Net consideration is 750. The last previous example I deducted 5 lakh. That was not correct. So now I need to apply the index number. So I am applying the index numbers 5 lakh into numerator 301 divided by denominator 167. By applying this, I am getting an amount of 9 lakh 1198. This is called as indexed cost of acquisition. This is called as what? Indexed cost of acquisition. Now similarly, you also give me the indexed amount for 1213. This cost of improvement. Your cost of improvement is 1 lakh. You apply the index number. Which 2 years index number would be relevant? Financial year 1213 and financial year 2021. Numerator index will be the index number of the year of transfer. Denominator index will be the index number of the year of acquisition. Are you all understanding? Harshit is asking me why brokerage is not inflated, sir. Harshit, brokerage pertains to which year? This brokerage is paid on purchase or it is paid on sales? Harshit? This brokerage is paid on sales na? Sales na? Oh Harshit, you have misunderstood then. You have misunderstood. Harshit, this brokerage is not paid on purchase, it is paid on sales. It is paid on sales. Read that point number 3. Mr. Holmes sold the residential property for 760, incurring a brokerage of 10,000. So this brokerage is not paid on purchase, it is paid on sale. And this already belongs to the year 2021. So there is no need of indexation. Yes, whatever brokerage you paid on purchase, on that definitely indexation is required to be applied. And that brokerage will be anyway part of this cost of acquisition. Cost of acquisition means purchase price of an asset plus all the expenditure incurred on the asset at the time of acquiring the asset and at the time of putting the asset to use. See, this cost of acquisition is nothing but, in accounting you learned a cost concept. It is same thing here. And in income tax also, in the chapter of PGBP, we learned something called as actual cost. We add the actual cost of a newly asset acquired to the block asset. So the actual cost same it is here. Here it is termed differently. It is called as cost of acquisition. So if you have paid any brokerage at the time of purchase, that will be added to your cost of acquisition. So that will be definitely indexed. Yes, so get me the amount of index cost for improvement. My cost of improvement is how much? 1 lakh rupees. Get me the amount of indexed amount. Deva, Vidya, Shri, I have got answer from 2 people. 1,50,500. So 1 lakh into 301 divided by 200. So the amount arrived is 1,50,500. Once I deduct this index cost of acquisition and index cost of improvement from my net consideration, the amount which is arrived is called as what? Is called as long-term gain or long-term loss. If it is positive, it is long-term gain. If it is negative, it is long-term loss. Yes, have you all understood this clearly? So we have understood the format for computation of short-term gain and format for computation of long-term gain. That we have understood. So in your textbook, we have completed which pages now? From page number 169 to page number 174. This is over. Page number 175, point number 2, index numbers is over. Point number 3, period of indexation. Partly it is over, partly it is yet to be discussed. That I will discuss with you over a period of time. Okay. So now I move on to one of the important points. We are on page number 175 of your book, which is giving you index numbers. And you already know that indexation benefit is available only in case of long-term asset. It is available only in case of long-term asset. Now listen to me very carefully. Now, if you look at these index numbers, these numbers are available from the financial year 2001 up to financial year 2021. Question is, what if you have acquired the capital asset prior to financial year 2001-2? Say for example, you might have acquired the asset in the year 1995. That capital asset you are selling in the current year 2020-21. That is a long-term asset. You have to take the benefit of indexation. But you don't have the index numbers from the period 95. Na? You are having index numbers only from 2000, 2002. Yes or no? Your year of acquisition, is, say for example 1995-96, and your year of transfer of capital asset is 2021, and the asset is long term, so you have to do indexation. So we'll take the cost of acquisition, we'll multiply that by indexation. Numerator index will be index number of the year of transfer, that is 2021, and denominator index is generally the year of acquisition, 95-96 in this case. But do we have the index number for 95-96 with us? No, we don't have it. So government says, since you don't have the index number for 95-96, you have the index number from which year? 2001-2. You have the index number for 2001-2. Manoj is asking me a question, sir, NRI can buy agricultural land in India? This is not part of income tax. I cannot answer. If I give you the answer, it may be a wrong answer. I do not know exactly. But if you want to buy an agricultural land, to the whatever I know, based on that I am giving you answer. I am not an expert of that property field, but whatever I know, I am just telling you the answer. Agricultural land, if you want to buy now, you should be a farmer. In India, you have to prove that you are a farmer. Either you are a farmer or your father, grandparents, etc. were a farmer. You will need to get a certificate. Only if you have a certificate saying that either you or your ancestors were farmers, then only you can buy the agricultural land in India. Otherwise, you can't. Forget about NRI. Even a resident person in India, if he wants to buy agricultural land, he has to prove that he is a farmer. So you cannot go to you cannot buy the agricultural land unless and until you prove that you are a farmer. Is that very clear? Manoj? Okay. Now I was telling you that from 95-96 up to 2001-2002, what will do about that indexation? Because you don't have the index numbers. 95, 96 to 2001, 2. You don't have the index numbers. So what about the indexation for this period? From 2001 to 2020, 21, you can definitely have the index, you have the index numbers, you can definitely apply the index numbers and get the index cost. But what about this period from 1995, 96 to 2001, 2002? Government doesn't have the index numbers, therefore government has come out with an option. Government has come out with an option saying that if you have acquired the capital asset before 1st April 2001, if you have acquired the capital asset before 1st April 2001, then we are giving you option. What amount you can consider as your cost of acquisition for computing capital gain? Na? You take your actual cost of acquisition. In our example, say for example 1995-96, I acquired the property for 1 lakh rupees. So I will take 1 lakh rupees, which is my actual cost of acquisition. That I will compare with fair market value of that asset on 1st April 2001. Don't you feel that fair market value will definitely include the inflation? Yes. Say for example 95-96, I acquired a residential property for 1 lakh rupees. Now I want the market price of 1st April 2001. That I can get it from the valuer. But don't you think that fair market value on 1st April 2001 will definitely include the inflation effect from 95-96 to 2001? Definitely it will include. So government says, since we are not having the index numbers for the period prior to 1st April 2001, we are creating an option for you wherein you can consider your actual cost of acquisition or fair market value on 1st April 2001, whichever is higher as your cost of acquisition. Say for example, your actual cost of acquisition is 1 lakh, but the fair market value on 1st April 2001 is say 2.5 lakhs. So that 2.5 lakh will definitely include an inflation. So 2.5 lakh, you consider it as your cost of acquisition. Thereafter, you apply the indexation from base year 2001, 2002 up to 2021. So your actual cost of acquisition is say 1 lakh. That you have to compare with fair market value on 1st April 2001. That is say 2 lakh 50. So we will take a higher of this as your cost of acquisition for computing capital gain. 2 lakh 50 will be taken as cost of acquisition for computing capital gain, and on that 2 lakh 50 then you apply the indexation. 2 lakh 50 multiplied by year of transfer 2021, indexation is 301. Denominator of indexation, denominator number will be index number of the year of index number will be of base year. Base year means 2001, 2002, and that index number is 100. Yes, have you understood this? Then you will get the index cost of acquisition for the financial year 2021. So whenever you have acquired the asset prior to 1st April 2001, you have the option of considering actual cost of acquisition or fair market value on 1st April 2001, whichever is higher as your cost of acquisition for computing capital gains. Now, it may happen that your actual cost of acquisition is 1 lakh and fair market value on 1st April 2001 is 80,000. So in that case, you take 1 lakh from, in that case, you take 1 lakh as your cost of acquisition. On that 1 lakh, you apply the indexation from 2001 to 2020-21. See, normally, generally, the fair market value itself will be higher. Actual cost will not be higher. Fair market value will be higher. But rarest of the rare situation, if at all fair market value is lower, you take the actual cost. Government has not made the provision for the rarest of situation. Government has not thought about that. Government has thought about the normal situation. So normally what will happen? Your fair market value on 1st April 2001 will be higher than the actual cost of acquisition. So take that amount as your cost of acquisition for computing capital gain. On that you apply the index numbers. You apply the indexation. Yes. Is that very, very clear? Have you understood this? Let me give you an example. Think about it. Based on this example, I am going to explain you one more point. Say for example, I acquired a residential house property. I acquired a residential house. Year of acquisition is 1995-96. Cost of acquisition is 1 lakh. Same numbers I am taking. And say for example, this property is sold by me in the year 2020-21. So for computing index cost of acquisition, first option, what do you have? You take the actual cost of acquisition, compare it with fair market value on 1st of 2001. So that you have done. Correct. So I have selected higher. I have selected higher out of this. Yes or no? This 2,50,000 will be considered as my actual cost of acquisition for computing capital gain. This much you might have understood. Now I am telling you, during the year 1998-99, I incurred an extra cost of 50,000 rupees to construct additional floor on the existing property. On that same property, I have constructed an additional floor. So here there is a staircase. This first floor was constructed in which year? 1998-99. This is constructed at a cost of 50,000. So that cost of 50,000 will be called as cost of improvement. The year in which this cost is incurred is called as year of improvement. Let me tell you that year of improvement is 1998-99. So ground floor cost is 1 lakh. First floor cost is 50,000. Correct? Ground floor 1 lakh is the cost of which year? 95-96. First floor. First floor cost is which year? 98-99. Now my question is, while you calculate capital gains, you are going to get deduction for the cost of acquisition as well as the cost of improvement. But in case of those capital assets which are acquired prior to 1st April 2001, since government did not have the index numbers, government has given you option, you take your actual cost of acquisition, you compare that with fair market value on 1st April 2001, you select whichever is higher and take that amount as your cost of acquisition for computing capital gain. Now my question to you is, if you have incurred some cost of improvement and that cost of improvement is incurred when? Before 1st April 2001. In this example, the cost of improvement of 50,000 is incurred before 1st April 2001. So on the date of 1st April 2001, you will be having only ground floor or you will also be having first floor? Definitely on the date of 1st April 2001, you will be having ground floor as well as first floor. So the point is, if you find out the fair market value of the property and you have found out the fair market value of the property as 2,50,000, don't you feel that is a fair market value of ground floor, first floor combined? That 2,50,000 which is the fair market value on 1st April 2001, that is a fair market value of which floor? Only ground floor or ground floor, first floor both combined? Definitely both combined. Because on first April 2001, you had the ground floor as well as the first floor. Therefore, if you are taking the deduction for this 2,50,000, if you are taking the deduction for this 2,50,000, don't you feel this market price of 2,50,000 will definitely include this cost of 50,000? Yes? Yes or no? Are you understanding? So, broadly speaking, this market price of 2,50,000 would consist of three things. Number one, it would consist of your cost of acquisition. It would consist of your cost of acquisition. How much is the cost of acquisition in your case? 1 lakh. It would also consist of your cost of improvement, which is 50. And the balance is nothing but inflation. Balance is nothing but due to inflation. That is 1 lakh. Yes or no? This 250 will anyway include this 50,000. So, if we give you a separate deduction for this 50,000 also, don't you feel that will amount to double deduction? That will amount to double deduction, yes or no? If I give you a separate deduction for 50,000, that 50,000 is also included in 2,50,000, that will amount to double deduction. So government doesn't have the intention of giving you double deduction. So here on page number 174 of our book, we have something called as cost of improvement. Here they have written cost of improvement incurred before 1st April 2001 cannot be claimed as deduction. Why it cannot be claimed as deduction? Because it is automatically covered by fair market value on 1st April 2001. Yes, have you understood this? So if you want, you can write the logic there. It is automatically covered by fair market value on 1st April 2001. So cost of improvement deduction will be allowed only if it is incurred on or after 1st April 2001. Cost of improvement deduction will be allowed only if it is incurred on or after 1st April 2001. Is that very, very clear? Yes, shall we proceed now? So we move on to the practical questions. We move on to the practical question and we'll be solving question number 2. Question number 2. See, question number 2, question is given on page number 176 and the solution format is given on page number 217. Solution format is given on page number 217. First of all, I'll read the question and then I'll move on to the solution. When I move on to the solution, you should give me the answers. X purchases a piece of land. See, I am reading the first question of this capital gain chapter. So how to read the question? What should be your thought process? Focus on that. X purchases a piece of land. So first question you should ask is whether this piece of land is a capital asset or not. Is it a capital asset? Piece of land? Yes or no? It belongs to which category? Category 2. So the period of holding applicable is 24 months. 24 months. So if the actual period of holding is more than 24 months, what you will calculate? You will calculate long-term capital gain. You will calculate long-term capital gain. So definitely this is long-term asset. Not right now you can't conclude, but this is definitely a capital asset. This was acquired on 4 January 2001. 4 January 2001. Looking at this date, 4 January 2001. Yes, what comes to your mind? It is acquired before 1st April 2001. Yes or no? Okay. It was acquired for 50,000. What is this 50,000? This is nothing but cost of acquisition. This is nothing but cost of acquisition. Now, the moment you see that the date of acquisition is prior to 1st April 2001, what should come to your mind is examiner should give you fair market value on 1st April 2001. Fair market value on 1st April 2001 should be given to you in the question. This land was sold. This land was sold. Sold. Do you believe sale is transfer? Yes. Sale is considered as transfer. So number one, there is a capital asset. Number two, there is a transfer. Number three, such transfer should take place during the, see such kind of analysis I am not going to do for all the question. All the question I will read quickly. Since this is the first question, I am referring to sentence by sentence, word by word, which word is important, from which word you can interpret what, all these things I am discussing. This land was sold by him on 2nd September 20. So what is the 2nd September 20? Date of transfer. Is it transferred during the previous year 2021? Yes. This is transferred during the previous year 2021. So section 45 subsection 1, there must be a capital asset. Do you believe land is capital asset? Yes. Section 45 subsection 1, second condition, there must be a transfer of capital asset. Is it transferred? Yes, it is sold. Transfer includes sale. Transfer should be during the previous year. Is it previous year? 2021. Yes, 2021 is the date of transfer. Such capital gain should not be exempt. Right now that condition will not be in a position to check because you have not learned the exemption of capital gain. Let us read further. What is this 20 lakhs? This is sold for 20 lakhs. So what is this 20 lakhs? This 20 lakhs is nothing but full value of consideration. Full value of consideration. The market value of this land on 1st April 2001 was 1,20,000. So what you will do? 50 or 120, whichever is higher, 120 will be taken as cost of acquisition for computing capital gain. Further it says expenses on transfer were 2% of sale price. So this is expense on transfer. This should be deducted from full value of consideration. Compute the capital gain for the assessment at 21-22. What would be the answer? That is a second situation. Forget about it right now. First of all, let us calculate the capital gain. Take into account only this much information. Let's move on to the solution part. So I move on to format. Look at this. Case A. If land was purchased on 4th January 21. Period of holding. Now you refer to the question. You have to refer to the question page as well as solution page simultaneously. Period of holding is from 4th January 2001 to 1st September. Why 1st September? You have to take 1 day prior to the date of transfer. Yes or no? Is that more than this land? Period of holding applicable is how much? 24 na? So this 36 by mistake it is appearing here. Make it 24. Make it 24. Shall I proceed? Do you believe this period is more than 24 months? Yes. Therefore, it is long-term asset. So then you will write statement showing computation of long-term capital gain. Then you will write statement of computation of long-term capital gain. Then you make the format. In income tax, there is no tension with respect to format, etc. It is always same, particular amount, that's all. Tell me what is full value of consideration? 20 lakhs. Write it in the outer column, 20 lakhs. How much is expense on transfer? 2% of sale price. Page number. Manoj, page number is 217. This format is given on page number 217 in your book. So you have to look at page number 176 and 217 simultaneously. Expense on transfer is 2% of this. That will be how much? 40,000. So our net consideration is 19,60,000. Index cost of acquisition. Forget about the index cost of acquisition. First of all, you have to ascertain the cost of acquisition. So I am writing here 0.1. Point 1 I am writing actual cost of acquisition. Point 1 is actual cost of acquisition. What is the actual cost of acquisition? 50,000. And since this actual cost of acquisition is prior to 1st April 2001, I will also have fair market value as on 1st April 2001. What is fair market value? 1,20,000. Then I need to select higher of 1 and 2. Higher of 1 and 2 is 1,20,000. On this 1,20,000 I should apply the indexation. I don't have the space, so I am writing here 1,20,000 multiplied by index number of which year? 2021. How much it is? 301. Divided by index number of base year, that is 2001-2. How much it is? 100. So what will be my indexed cost of acquisition? 361,200. So I am writing here 361,200. Do you have any cost of improvement? No. So 0. Let me take this amount to the outer column. 361,200. Once I deduct this, I would arrive at the amount of capital gains, long-term capital gain. 15,98,800. 15,98,800. Have you all understood this calculation very clearly? Format is very simple, no one is going to forget. But you have to remember the provisions. If the cost of asset, year of acquisition of asset is prior to 1st April 2001, you have the option of considering fair market value on 1st April 2001 as your cost of acquisition. Cost of improvement incurred prior to 1st April 2001 cannot be claimed as deduction. All these provisions you have to remember. As and when we progress in this chapter now, the complex situation will come. Solution size will remain the same, but you have to apply multiple provisions at the same time. For everything there is a small provision. So case A is over. Now I move on to the question once again. If you refer to the question, see, last line says what? What would be the answer if the land was purchased by him on 1st April 2009 for 2,50,000? So what information they have changed? They have changed the year of acquisition and they have also changed the cost of acquisition. Now they are asking you to recalculate the capital gain. So give me the amount. My full value of consideration will remain the same, 20 lakhs. Definitely my period of holding will change. It's from which date? First April to 1st April 2009 to 1st September 20. This is greater than how many months? 24. Cancel this 36 months here. Make it 24. Then you take full value of consideration 20 lakhs. Expense on transfer 40,000. Net consideration is 19,60,000. Yes. Now do you have the option of FMV on 1st April 2001? Yes. Will you take into account fair market value on 1st April 2001? No. You have to just take into account your actual cost acquisition, which is how much? 2,50,000 multiplied by index number of which year? 2021, that is 301, divided by denominator index of which year? 2009-10. What is the index number of 9-10? 148. So what is my index cost acquisition? 5,08,446. And index cost of improvement is 0. So let me take this amount to the outer column, 5,08,446. I'll put this into bracket. I'll deduct this to get the amount of long-term capital gain. It is 14 lakhs 51,554. Yes, is that very clear? Yes? Do you have any doubt? If you have any smallest of the doubt, please do ask. Otherwise, you will be facing more difficulties. Shall I proceed? See, question number 2, I have the solution with me. What answer you gave me? 1451,554. Did we calculate that same amount? 1598,800. 1598,800 and 1451,554. Correct? So, even if we are solving the questions in the class, you are copying those questions in the solution format, still you are going to get this PDF. That PDF will have entire solution along with lot of examples for understanding different concepts. So, now I move on to tax treatment of securities transaction tax. Securities transaction tax you are going to understand. Now listen to me carefully. I just want to go to page number. We have a definition of expense on transfer. We have a definition of cost of acquisition also. Now refer to this definition of cost of acquisition very carefully. Refer to the last line which says, however, as per section 48 proviso 7, as per Rizwan, I told that any cost of improvement incurred prior to 1st April 2001 cannot be claimed as reduction because that cost of improvement will be automatically covered by fair market value on 1st April 2001. That will be automatically covered by fair market value on 1st April 2001. I took this example to make you understand. Na? Here, what is the cost of acquisition? In this example, my cost of acquisition is 10 lakhs, of which year 95, 96. What is the fair market value on 1st April 2001? 2,50,000. Have I incurred the cost of improvement? Yes. In which year? 98, 99. Have I incurred it prior to 1st April 1st April 2001? Yes. So when I acquire the asset prior to 1st April 2001, instead of this cost of acquisition, I have the option of taking 2,50,000, which is my fair market value on 1st April 2001 as my cost of acquisition. So in cost of acquisition, I am going to take this 2,50,000 now. Don't you feel that this 2,50,000, which is the market price, will definitely include the cost of improvement incurred prior to 1st April 2001? Market price of this entire house is 250 na? Rizwan? So this 250 will include the value of ground floor as well as first floor. Yes or no? Rizwan, are you getting my voice? Have you understood? So cost of improvement incurred prior to 1st April 2001, we are not giving deduction because it is automatically covered by fair market value on 1st April 2001. Now, I was referring to page number 174. Listen to me carefully now. In the chapter of PGBP, Manoj, first question answer we have rectified na yaar. First question point number 1. Are you talking about first question point number 1? Mr. Manoj? Yes, na, that we have rectified, correct? Instead of 36 months, we made it 24 months. Instead of less than 36 months, we made it more than 24 months. Okay. Now listen to me very carefully. In the chapter of PGBP, I had explained you section 36 subsection 1. In that one point was securities transaction tax. At that point of time, I had told you that securities transaction tax we will also discuss when we move on to the chapter of capital gain. Now listen to me very carefully. Whenever you enter into any transaction for purchase or sale of securities through a stock exchange, you have to pay securities transaction tax. Correct? Securities transaction tax is payable on purchase of securities as well as sale of securities. Now there can be two possibilities. Number one, securities are stock in trade for you. Securities are stock in trade for you. And number two, securities are not stock in trade for you. Securities are investment for you. If securities are stock in trade for you, securities transaction tax deduction is allowed under section 36 subsection 1. And whatever profit is generated by purchasing and selling securities, that profit is also taxable under that PGBP. So securities transaction tax can be claimed as deduction in section 36 subsection 1. This I have already explained you in the chapter of PGBP. I have just revised it. Now comes the discussion with respect to capital gain chapter. If these securities if the securities are held as investment for you, if you are holding the securities as investment, then securities transaction tax deduction is not allowed. Deduction is not allowed. Where it is written? Let us refer to this cost of acquisition definition. It says in last line it says, however, as per section 48 proviso 7, securities transaction tax shall not form part of cost of acquisition. So any securities transaction tax paid at the time of purchase should not be added to cost of acquisition. Also refer to the definition of expense on transfer. Here also it says section 48 proviso 7, any securities transaction tax paid is also not allowed as deduction. So any securities transaction tax paid at the time of sale should not be deducted from full value of consideration. It should not be taken into account. It should not be considered as part of expense on transfer. To make you understand how the calculations will work, I have taken an example here. Look at this. For example, you have purchased the securities at 100 rupees. At the time of purchase, you paid a securities transaction tax of 1 rupee and you paid brokerage of 2 rupees. So what will be considered as your cost? Your cost should be how much? Your cost should be 103 na. As per normal accounting understanding, your cost should be 103. Deva madam, I am not talking about income tax. First of all, I am talking about accountancy. In accountancy, your cost will be considered as 103. Correct? Now we have sold the securities at 200. At the time of sale of securities, you have paid 2 rupees as securities transaction tax and 4 rupees as brokerage. In accountancy, you know na, at the time of sale, whatever expenditure you incur, that should be deducted from the selling price. So what is the net selling price? My net selling price is how much? 194. 194. Now you tell me what is the difference of my net selling price and cost price? 91. This 91 is profit. This 91 is profit. Now generally this is the manner in which profit will be computed. This is the manner in which profit will be computed. But in income tax we are saying that this securities transaction tax should not be taken into account. In other words, this should be ignored. Forget about this. So don't take into account this securities transaction tax. So this securities transaction tax which you have incurred, it should not be added to purchase price. It should not be deducted from the sale price. So exclude this both from cost of acquisition, from expense on transfer also. So in this case, if we calculate capital gain, what will be our full value of consideration? 200. What will be our expense on transfer? Only brokerage on sale, which is 4 rupees. So the net selling price as per income tax net consideration will be 196. And cost of acquisition will be 100 plus 2 rupees brokerage, 102. So what will be our capital gain? It will be 94. Your capital gain will be 94. But your actual profit is how much? Your actual profit is 91 only. You have earned how much? 91. But you have to pay tax on how much? 94. Because government says securities transaction tax we will not allow you as deduction. As a result of which your capital gain amount will increase by the amount of securities transaction tax. Yes, have you understood this? Yes or no? Shall I proceed? See, a natural question may come to your mind, why this securities transaction tax is not allowed as deduction? This is also an expenditure. Why it is not allowed as deduction? For this, there is a very old story. Prior to, I think it was 1997 or 2004, I don't remember it correctly. I think it was 2004, yes. Congress government came in 2004, yes, it was 2004. So it is a very old story of 2004. Now that story has lost its relevance. Securities transaction tax was introduced in the year 2004. Before that, there was no securities transaction tax in India. Why it was introduced now? There is a very long story, but that story has lost its relevance. So I don't want to get into it right now and waste my time. You have to just remember that securities transaction tax should not be taken into account while computing capital gain. Securities transaction tax should not be taken into account while computing capital gain. See page number 175 of your book. Page number 175, point number 1, point number 2, point number 3 is over. Point number 1, 2, 3 both are over. 3 points are over. Dixit, our time will be wasted unnecessarily. 15-20 minutes will be wasted. Why I am not telling you now? You will not understand also right now. At the end of the chapter, there is one section, section 112A. Before that, there was one section, section 10 clause 38. Now 1038 is removed. 1038 is removed. Therefore, the story has lost its relevance. If at all we have some time at the end of the chapter when we move on to that section 112A, at that point of time I will tell you. Point number 4. Point number 4 na. I have given you 5 different formulas. Actually, every formula is same, only slight changes. First is done, second is also done. What is first? Capital asset acquired by the SSE himself before 1st April 2001. How to calculate index cost acquisition? You take the actual cost acquisition, you take the FMV on 1st April 2001, you select whichever is higher, multiply that by index number of the year of transfer, divide it by base year index number. So point 1 is over, first formula is gone. Second formula, if the capital asset is acquired on or after 1st April 2001, you take the actual cost acquisition, multiply it by numerator index, which is index number of year of transfer, divide it by denominator index, which is index number of the year of acquisition. So these two formula we have completed. Index cost of improvement, this formula is also done. Any cost of improvement incurred prior to 1st April 2001 cannot be claimed as reduction. So cost of improvement can be claimed as reduction only if it is incurred on or after 1st April 2001. And indexation of cost of improvement will be done in what manner? You take the cost of improvement incurred on or after 1st April 2001, multiplied by index number of the year of transfer, divided by index number of the year of improvement. So this point number 5 is, to a very great extent, it is self-explanatory. So whatever things we have done, I am just marking it. Now I am moving on to page number 178. Page number 178. I'll go through this page number 178 very quickly. I'll go through it very quickly. The moment I read the left hand side, na, first column in this table is given to you. Table is having 3 columns. The moment I read the first column, na, second column, third column, answer you should know. So this table is giving you this table is giving you cost of acquisition for different situations. In case of shares, in shares you have original shares, you have bonus shares, you have right shares, you have rights. A person can transfer, renounce his right. So we need to discuss what is the tax treatment in the hands of renouncer, what is the tax treatment in the hands of renouncee. Your investment accounting chapter is over in accounts. Investment accounting chapter is over. So you might definitely understand what is renouncement, renouncer, renouncee, everything. So let us move on to this. Original shares acquired before 1st April 2001. You have acquired the shares prior to 1st April 2001. See, if you purchase the shares from the company na, in IPO or in FPO, if you acquire shares from the company, then you will make an application to the company. You will make an application to the company and then company will actually make the allotment. So period of holding should not be taken from date of application of share. This should be taken always from the date of allotment, because only on the date of allotment you become the shareholder. But if you have purchased the shares from open market, then you should take the date of purchase as your date of acquisition. So original shares, period of holding is from date of allotment to date of transfer. What should be the cost of acquisition? Original shares, what should be the cost of acquisition? If they are acquired prior to 1st April 2001, what do you consider as the cost of acquisition? Actual cost of acquisition or fair market value on 1st April 2001, whichever is higher. Yes or no? Higher of actual cost of acquisition or fair market value on 1st April 2001. Have you understood this? I am putting the serial numbers here. Shall I proceed? Yes. So we need to discuss 9 points. In fact, there is no discussion. You already know this. Original shares acquired on or after 1st April 2001. Period of holding will be from date of allotment to the date of transfer. In this case, what will be the cost of acquisition? Option of FMV on 1st April 2001 is not available, because you have acquired the shares on or after 1st April 2001. So your actual cost will be considered as cost of acquisition. Amount actually paid for acquiring the shares will be considered as cost of acquisition. Yes, shall I move on to next point? Point number 3. Yes, bonus shares are allotted to the SSE before 1st April 2001. Bonus shares are allotted. See, bonus shares are first announced. Thereafter, they are actually allotted. So, date of announcement is irrelevant. Date of allotment is important. So, bonus shares, the period of holding will be from date of allotment to date of transfer. Since these bonus shares were acquired prior to 1st April 2001, actual cost of acquisition is definitely 0. But you have the option of considering FME on 1st April 2001 as your cost of acquisition. See, you may think that actual cost is 0. Why FME should be taken into account for computing capital gain? Because government has created option, and while creating such option, government has not thought about each and every situation. Government has not micromanaged the provision. Government made a simple provision saying that if you acquire some capital asset prior to 1st April 2001, since we do not have the index numbers, we are giving you the option of considering your FMV on 1st April 2001 as your cost of acquisition. But while making this provision, government did not think that there can be an asset wherein the cost of acquisition can also be 0. That never came to the mind of the government. Therefore, you are getting the advantage, you take the advantage. Your cost of acquisition is 0. You consider the FMV on 1st April 2001 as your cost of acquisition. So, if you have something as cost of acquisition, your capital gain will be less, tax liability will be less. Next is bonus shares allotted on or after 1st April 2001. Period of holding will be from date of allotment to date of transfer. Your FMV option is not available. FMV on 1st April 2001, this option is not available. Yes or no? And your actual cost is 0. So nothing is, cost is 0. Nothing should be taken as cost of acquisition. Your net consideration itself will become the amount of capital gain in this case. Yes? Shall I proceed to 5th point? Yes or no? Okay, let's move quickly. Right shares are subscribed. What do you mean by right shares are subscribed? Company has given you a right to acquire the shares and you have subscribed, means you have paid money to the company and you have purchased the shares. Those shares are sold. Right shares subscribed on the basis of right entitlement, and these right shares were subscribed prior to 1st April 2001. In this case, you will have the option of 1st April 2001 FMV. Na? You take that. Number 2, take the cost acquisition. Amount actually paid to the company for acquiring right shares. Whatever amount you paid to the company for acquiring right shares will become your actual cost acquisition. That should be compared with fair market value on 1st April 2001. Whichever is higher should be considered as cost acquisition. Period of holding will be same. Date of allotment to date of transfer. Date of announcement of right, date of exercise of right, all these dates are irrelevant. Date of allotment is to be taken into account. Point 6. Rights shares subscribed on the basis of entitlement received on or after 1st April 2001. In this case, FMV on 1st April 2001, this option will not be available. So, amount paid to the company for acquiring the right will become your cost acquisition. Yes, is that very, very clear? Point 5, point 6. Point 5. Rizwan, point 5 is right shares. You have paid money to the company to acquire the shares. And those shares are acquired before 1st April 2001. Na? So you have the option of considering FMV on 1st April 2001 as your cost acquisition. So whatever you paid to company, that should be compared with FMV on 1st April 2001. And you should select whichever is higher as your cost acquisition for computing capital gain. It is similar to first situation. Situation 5 is similar to first situation. Only difference is those are original shares, these are right shares. In that case, actual cost acquisition is purchase price. In this case, that is amount paid to the company. That's all. The rest everything is same. Rizwan, shall I proceed? Okay, next. Now listen to me carefully. See, there is something called as renouncement. Renouncement. When company is in need of additional funds, company will offer the right shares to the existing shareholders. Existing shareholders will have an option to subscribe to the shares at a lower price as compared to the market price. Now the shareholder who has received the right, he is having two options. Option 1, acquire the shares. In that case, he will have to pay money to the company and company will allot him the shares. Option 2, if he doesn't want to acquire the shares, what he will do? He will transfer his right to acquire the shares to another person. He will transfer his right to acquire the shares to some other person at a cost. That transfer is called as renouncement. The person who is transferring his right is called as renouncer. The person to whom the right is transferred is called as renouncee. The entire process is called as renouncement. I am not getting into the details of this because you might have understood this in accountancy. Yes or no? So I move on to this renouncement part, but before that I have Deva has asked me a question. Sir, bonus shares are given in relation to original shares held by the person. So can't it be treated as improvement cost? See madam, bonus shares cost is 0 only. Number 1, bonus shares cost is 0. And number 2, bonus shares are altogether different shares. Because of bonus, your number of shares will increase. And it's not necessary that you may sell all your shares. Na? It may happen that you might sell your original shares and your bonus shares you have kept with yourself only. Bonus shares are separately identifiable shares. They have their own identity. Are you understanding? For considering something as the cost of improvement, there should be some cost, na? For bonus, you are not incurring any cost. So how can you say that it should be considered as cost of improvement? Even if you want to consider something as cost of improvement, first of all, there should be some cost, na? In bonus, there is no cost. So let us move on to this last 3 points, 7, 8 and 9. Then we will move on to practical question. Question number 3. Quickly, I'll go through this point 7 and 9. Point 7 says what? Right to acquire such a share in case such a right is renounced. Means there is a renouncement of right. This right is renounced in favor of any other person. What will be the tax treatment in the hands of renouncer? First of all, you tell me, right is renounced means what is renounced? Tangible asset is renounced or intangible asset is renounced? The right which is renounced belongs to which category? Is it a capital asset? If yes, it belongs to which category? Yes? So you are of the opinion that it is intangible asset. So it should belong to which category? Right which a renouncer is transferring to renouncee. It is an intangible asset. Is it a capital asset? Yes. So it should belong to which category? It should belong to third category. Period of holding applicable should be 36 months. But do you believe that from the date of announcement of right to the date of renouncement of right, the period will be more than 12 months also? No. Because as per the SEBI guidelines, the period from the date of announcement of right to the date of allotment of right should not exceed more than 60 days. That is SEBI guidelines. So in case of renouncement of right, see, date of renouncement will always be before the date of allotment of shares. So your period from date of announcement of right to the date of renouncement of right will always be even less than 60 days. So definitely it will be less than 36 months. So it will always be short term asset. And what is the cost of acquisition? 0. You have received this right from the company free of cost, so your cost of acquisition is 0. Whatever money renouncer has received from whatever money renouncer has received from renouncee, that will be considered as full value of consideration. That itself will become your net consideration and capital gain. And this gain will always be which gain? Short-term capital gain. Short-term capital gain. Yes, have you understood this? So renouncer is transferring intangible asset called as right. Period of holding applicable is 36 months. The actual period of holding will always be less than 36 months. It will be generally less than 60 days. So it is a short-term asset. You have to calculate short-term gain. Whatever amount renouncer has received from renouncee should be considered as full value of consideration. That same amount will be considered as, that will become your net consideration as well as short-term gain. Point number 7 I have completed. Do you have any doubt? Point 7. Shall I proceed? See this this table which I have given you on this page, this will not find out in any book. I have intentionally created this table to give more detailed understanding with respect to shares. Actually, there is no separate explanation for this. Let's move on to last part. Shares are subscribed to on the basis of purchase of right entitlement before 1st April 2001. Shares are subscribed. Company has given you right. Company has allotted you right. You have exercised your right. You have given money to shares, money to company, and you have acquired the shares. In that case, what should be considered as your cost of acquisition? Your period of holding will be from date of allotment to date of transfer. What should be considered as your cost of acquisition is higher of amount paid by the renouncee to the company. Higher of amount paid by renouncee to the company. You tell me what is the cost of shares to the renouncee? Once the renouncement is done, renouncee will exercise the option, na? He will purchase shares from the company. So in that case, what will be the cost of acquisition of those shares in the hands of renouncee? Renouncee has paid money to renouncer as well as to company, yes or no? Renouncee, while acquiring the shares, he has paid money to renouncer as well as to the company. So whatever amount is paid by renouncee to the company for acquiring the shares plus the amount paid by the renouncee to the renouncer, both should be added. Both should be added. That will become your cost of acquisition. That should be compared with fair market value on 1st April 2001. Whichever is higher should be considered as a cost of acquisition. Is that very, very clear? Yes or no? Let's move on to the last point, point number 9. See, point number 8 and point number 9, both are treatment in the hands of renouncee only. Both are treatment in the hands of renouncee. What is the difference? In point 8, renouncee has exercised his right prior to 1st April 2001. In point 9, he is exercising his right on or after 1st April 2001. So, option of FMV on 1st April 2001 will not be available here. So, what will become cost? Amount paid by the renouncee to company plus amount paid to renouncer for renouncement. Addition of both will be considered as cost of acquisition. So, with this we have covered 9 points. Section 48 Proviso 7, I have already explained you. Securities transaction tax should not be taken into account for the purpose of computing capital gain. Neither it should be added to cost of acquisition, nor it should be deducted from the full value of consideration, considering it to be expense on transfer. Securities transaction tax should be totally ignored. Yes. So we have covered this page number 178. Now we have question number 3. Question number 3. Very simple question it is. Page number 178. 179. Page number 179, question number 3. We will quickly go through it and we will solve it. It will not take more than 5-7 minutes time. X purchases 1000 equity shares at the rate of 16 rupees per share and brokerage is 1%. Equity shares, are they considered as capital asset? Yes. If listed, they are covered by category 1. If they are unlisted, they are covered by category 2. The 16 rupees per share, to that you add brokerage 1%. So your cost of acquisition will be 16.16. Your cost of acquisition will be 16.16. These shares are acquired on 10th December 2000. Yes. What do you understand by this 10th December 2000 date? 10th December 2000, what do you understand? These shares are acquired prior to 1st April 2001. So, examiner should give you fair market value on 1st April 2001 in the question. Correct? Let us proceed. He gets 500 bonus shares by virtue of his holding 1000 shares on 10th January 2001. What do you understand by this 10th January? These bonus shares are also issued before 1st April 2001. So in this bonus shares also you will be having an option of considering FMV on 1st April 2001 as your cost of acquisition. Fair market value of shares of A Limited on 1st April 2001 is 24 rupees. See, very important point to be noted. Listen to me very carefully. What mistakes the students do? Students generally do in the examination is they take the cost of acquisition as 16 rupees. They take the cost of acquisition as 16 rupees. Then they take the fair market value on 1st April 2001, which is 24 rupees. Then out of 16 and 24, they select whichever is higher. So they select 24. And then to that 24, they add 1% brokerage. Brokerage should not be added after selecting higher of actual cost and FMV. Brokerage should be added to the actual cost only. Are you understanding? Don't compare 16 and 24 and then select whichever is higher, that is 24, and then add brokerage on 24. You have to add brokerage on 16. So your actual cost will be 16.16. That 16.16 needs to be compared with 24. Yes? Have you understood this point? Let us proceed. On 13th March 21, he transferred 1000 bonus shares at 400 rupees per share. Brokerage paid is 1.5%. So you calculate capital gain on transfer of 1000 original shares. You calculate capital gain on transfer of 1000 original shares. Further it says, on 15 March 21 means just after 2 days, he also transfers 500 bonus shares at 401 per share. Brokerage is 1.5%. Compute capital gain. Last sentence of the question, you forget about it. Right now you forget about what they are saying in the last sentence of the question. Let us move on to the solution. In your textbook, format of the solution is given on page number 218. So you can move on to page number 218. And I can give you maximum 3 minutes time, maximum. Question number 3, solution format is given to you on page number 218. Refer to this, quickly fill up the blanks. What is the answer? What is the capital gain on transfer of 1000 original shares? Yes? $321,760. 321,760. Yes? So you can confirm the answer. Your full value of consideration is 4 lakhs. Your expense on transfer might be 6,000. Net consideration 394. Actual cost acquisition 1000 shares into 16.16 compared with 24, which is higher, 24. So 1000 shares into 24 is 24,000. 24,000 into 301 divided by 100 will give you index cost of acquisition is 72,240. No cost of improvement. Taxable long-term capital gain is 321,760. Now you tell me what is the long-term capital gain on transfer of those 500 bonus shares. Bonus shares actually it should be half of this. It should be half of this. Because bonus shares are 500, these are 1000. And bonus shares are also acquired prior to 1st April 2001. In that case also you are going to consider actual cost 0, FMV 24, which is higher 24. So you are going to consider 24 as your cost acquisition. Here also you have done the same. Oh, yes. 1 rupee there is a difference, yes. Vidya Shri has identified one thing. There is a difference of 1 rupee in the selling price. So if you divide that 321,760 by 2, 321,760, if you divide it by 2, whatever amount you get, from that you deduct 500 rupees. 321,760 divide by 2, whatever amount you get, from that you deduct 500 rupees. So you will get 161,373. So that is the amount of your capital gain on transfer of 500 bonuses. Yes, are you all getting this? Yes or no? Yes. Okay. Shall I proceed now? Now let's move on to the question and read the last sentence of the question. Let us read the last sentence of the question. See what it says. What it says. What would be the answer if the bonus shares are received on 10th April 2001? What would be the answer if the bonus shares were received on 10th April 2001? If 10th April 2001 bonus shares are received, then the actual cost is 0. Actual cost is 0. You don't have the option of considering FMV also. So what will become your capital gain? Net consideration itself will become your capital gain. Yes or no? So in that case, your aggregate capital gain will be 321,760 plus 197,492. Right now your aggregate capital gain is 321,760 and 161,372. This is 483,132. But the second case, if bonus shares are received on 10th April 2001, original capital gain will remain the same, 321,760. Bonus shares capital gain will be 197,492. So your aggregate capital gain will be 519,252. Yes. So we have completed this question number 3. Now I am going to cover multiple sections here, altogether separate situation. Listen to me carefully. Now I will be discussing a situation with you wherein we will be taking up multiple provisions at the same time. I will be discussing part of section 47, section 2 clause 42a, section 49 subsection 1, section 48 proviso 2, and also a very landmark judgment, CIT versus Manjula Shah of Bombay High Court. Up to last year, CA Institute has given this judgment in the module, and CA Institute was also making an alternate solution as per this judgment. May 21 module, they have removed this because it is a Bombay High Court judgment. There is no equivalent judgment of Madras High Court, but we have an equivalent judgment of Delhi High Court. So for the same question, we have two different solutions. So first of all, forget about whatever it is. I am going to explain the situation entirely. Say for example, listen to me carefully now. I am taking the example. Manoj is having an affair. Mr. Manoj is having an affair with Maitri. So Mr. Manoj is having an affair with Maitri. So Manoj decided to gift a gold chain to Maitri. So he has acquired a gold chain. Year of acquisition is say 2015-16. Actually, he had acquired a gold chain long back on the expectation that someone will come in my life. Cost of acquisition of gold chain is say for example 2 lakhs. Now, in the year 1920, Manoj has gifted this gold chain. Gifted gold chain in the 1920. Let me tell you the specific date. It is 15th August 2019, Independence Day. So Manoj has got independence from his bachelorship. That is what he feels. So he has gifted a gold chain to Maitri. See, this was a one-sided affair. Manoj felt that he is loving that girl, so he gifted a gold chain. The moment that girl has received the gold chain, next day onwards, she has stopped contacting Manoj. And Manoj is contacting her continuously. She is not picking up the call. Everything is over. That girl has sold the gold chain. Sale of gold chain. Gold chain is sold. Exactly after 1 year. 15th August 2020. This gold chain is sold. In this situation, how you will compute the capital gain? Or in this situation, what are the provisions in Income Tax Act? That is what we need to understand. I need some space, so I am writing here. Gold chain. Year of acquisition is 15-16. Cost of acquisition is 2 lakhs. Now listen to me carefully. Who has sold the gold chain? Maitri has sold the gold chain. So who will compute capital gain? Definitely Maitri will calculate capital gain. But we need to understand everything. Right from the first event to the last event, what will be the tax treatment? So what is the first event? First event has taken place in the year 15-16. What is that event? Manoj has acquired the gold chain. In which year? 15-16. So what is the consequence in the year 15-16? 15-16, there is no tax treatment. There is no tax treatment. Why? Because capital gain is not gain on acquisition, it is gain on transfer. So right now gold chain is not transferred, it is acquired. So no tax treatment, neither in the head capital gain nor in any other head. 15-16 no tax treatment. Next year is 1920. Next year is 1920. 1920 Let me get some more space for me. 15, 16. No tax treatment. Now I am talking about 1920. 1920 na. We need to understand what will be the tax treatment from the point of view of Mr. Manoj. What are the provisions in the Income Tax Act for Mr. Manoj? In which year? 1920. What is that year? 1920 is the year of gift. So Manoj is transferor and Miss Maitri she is transferee. So we need to understand two things. In the 1920, what will be the treatment in the hands of Manoj and what will be the treatment in the hands of Maitri? I need to cover up two situations here. So what I am doing now, I am changing the amounts. The gold chain value is not 2 lakhs. I am making it 20,000 first of all. 20,000. Now what will be the treatment in the hands of Manoj? Manoj has gifted the gold chain. Manoj has transferred the gold chain. Ownership of gold chain is transferred from Manoj to Miss Maitri. Here section 47 is applicable. Section 47 is applicable. What section 47 says na? Listen to me. Section 47 says any transfer of capital asset by way of gift, by way of will, by way of inheritance, by way of succession, by way of devolution or on account of partition of HUF. These things are not considered as transfer. And since these things are not considered as transfer, there will not be any capital gain in the hands of transferor. Sorry. Generally what happens? Capital gain is calculated in the hands of transferor. But we have section 47 which gives you the exceptions of transfer. Means section 47 gives you the list of situation wherein certain transactions are not considered as transfer. For levying capital gain tax, there must be a capital asset, there must be a transfer of capital asset. So, section 47 is an exception. Section 47 is giving you the list of transactions which are not considered as transfer. In other words, if your transaction is covered by section 47, we will say that it is not a transfer. If it is not a transfer, then section 45 subsection 1, one of the condition is not fulfilled. So capital gain is not required to be computed. So we say that in the year 1920, in the hands of Manoj, this transaction of giving gift is not considered as transfer. So Manoj is not required to calculate capital gain. Section 45, subsection 1 fails. Capital gain will not be calculated in the hands of Manoj. Is that very clear, this part, left hand side? What is the treatment in the hands of Manoj? Have you understood this very clearly? Let us proceed. What is the treatment in the hands of Maitri? See, treatment in the hands of Maitri, I am just telling you, but this will be covered in detail in the chapter of IFOS. What is the treatment in the chapter of IFOS? I am just sharing with you. Income from other sources, For Maitri, Manoj is not a relative. If they both would have married, husband wife for each other, they would be considered as a relative for each other. But they have not married. So for Maitri, Manoj is not a relative. She has received a gift. What is the value of that gift chain, gold chain? Fair market value In the year 1920, say 30,000. So in the chapter of IFOS, we learn that if the value of gift is less than equal to 15, no tax will be levied. Gift is taxable only when the value of gift is more than 50,000. So here, since the fair market value is less than equal to 50,000, it is not taxable. Where it is not taxable? Under the head income from other sources. So in the hands of Maitri, there is no tax treatment in the year 1920. Now comes the year 2021, last year. 2021. Now first of all, do you believe gold chain is a capital asset? Definitely yes. Belonging to which category? Category 3. Period of holding applicable is what? 36 months. Now the point is, in the year 2021, gold chain is sold. So first of all, you tell me, you should take the period of holding from which year? Period of holding should be taken from which year? Should it be taken from 1516 or should it be taken from 1920? It should be taken from 1516. That is what we discussed in point number 4 in question number 1. Period of holding will be taken from 1516 to 14th August 20. This is greater than 36 months. Therefore, it is long-term capital asset. And the gain will also be long-term gain. Yes. Full value of consideration. Say for example, Maitri has sold this gold chain. Selling price is 50,000. So how she would calculate capital gain? Full value of consideration 50,000 less expense on transfer, say for example 0, net consideration, how much? Expense on transfer 0. So net consideration will remain the same, 50,000. Now, what should be considered as cost of acquisition? Maitri has received this gold chain free of cost, and the value of gold chain on that amount, nothing was taxed to her under the head income from other sources also. So what should be taken as her cost of acquisition? Logically, her cost of acquisition is 0. And since nothing is taxable under that IFOs also, there is no cost. But we have section 49 subsection 1. We have section 49 subsection 1 which says what? Listen to me very carefully. We have section 49 subsection 1. This section says that when any asset is acquired by way of gift, will, inheritance, succession, devolution, on partition of HOA, etc., then the cost of acquisition of SAC, Maitri, is actually 0, but her cost of acquisition will be deemed to be the cost of acquisition of previous owner. Her cost of acquisition will be deemed to be the cost of acquisition of previous owner. So what is the cost of acquisition of previous owner in our example? Cost of Manoj, how much is that? 20,000 rupees. That should be taken as Maitri's cost of acquisition. Are you understanding? This is because of which section? Section 49 subsection 1. Now, since this is a long-term asset, we should apply the indexation. Now, my question to you is, what is the numerator index? Numerator index is definitely index of year of transfer, that is 2021. How much is that? 301. Denominator index should be taken of which year? Denominator index should be taken of which year? Should it be taken of the year 1516 or should it be taken of the year 1920? Denominator index logically 1516, but section 48 proviso 2 which talks about indexation says that indexation is available to the SSE. It says what? Indexation is available to the SSE. Who is SSE? Maitri is SSE. So indexation is available to SSE from the year in which asset is acquired by the SSE. So indexation will not be available from 1516. It will be available from the year in which Maitri acquired the asset. Because section 48 proviso 2 which gives the benefit of indexation uses the language indexation would be available to the SSE from the year in which asset was first held by the SSE. So logically indexation should be taken from 1516, but lawfully indexation should be taken from 1920. This you may not be in a position to digest, but this is the fact, this is law. So what is the index number of 1920 to 89? So now you get me the cost of index cost acquisition. This is long term asset. So in case of long term asset you get the benefit of indexation. Numerator index is always index number of the year of transfer. Denominator index is generally the index number of the year of acquisition. So the question is, what is the year of acquisition in this case? Maitri has acquired the asset in 1920. Manoj had acquired the asset in 1516. So indexation should be taken from which year? As per section 48 proviso 2, it should be taken from the year in which asset was acquired by the SSE. That is what is written. It is illogical, but it is lawful. So your index cost of acquisition will be 20,830. 20,830 will be index cost of acquisition. 20,830. So what will be the amount of long term gain in this case? Long term capital gain? 29,170. 29,170. Have you understood this much? Yes? Now listen to me carefully. Rakesh is asking me, sir, if there is no section 40 and 1 means, then what's the condition? Rakesh, if there is no section 40 and 1, in that case, Maitri would have purchased the asset na. 40 and 1 covers the situation of gift, will, inheritance, succession, devolution, etc. If there is no such situation, then we have to take up the indexation from the year in which Maitri had purchased the asset. So we are not talking about purchase, we are talking about gift. Rakesh? Okay, now listen to me very carefully. This star mark I have put this star here. Now I am telling you that as per section 48, proviso 2, indexation is available to the SSE from the year in which what? Capital asset is acquired by the SSE. acquired by the SSE. Now, very important point, I am giving you note 1 here, note 1, note 1, note 1. Now listen to me carefully. We have a Bombay High Court judgment, CIT versus Manjula Shah. CIT versus Manjula Shah, Bombay High Court judgment. As per this judgment, that logical solution will be followed. What is that logical solution? Indexation should be taken from which year? 1516. In our example, 1516. So, as per CIT versus Manjula Shah, indexation will be available to the SSE from the year in which capital asset is acquired by whom? Acquired by previous owner. So in this case, indexation will be available from which year? 1516. So my cost acquisition will change. Cost acquisition will remain the same. Year of indexation will change. If year of indexation changes, my index cost acquisition will change. My capital gain will also change. So let us calculate the revised capital gain. What will be the full value of consideration? Same number, 50,000. Expense on transfer 0. Net consideration 50. Index cost acquisition. What is cost acquisition? 20,000. Multiply by index number of the year of transfer, 2021. Are you all understanding this? Divide by indexation of the year in which capital asset was acquired by the previous owner. That is which year? 1516. What is the lucky number of 1516? 254. So calculate the index cost. 23,701. What will be long-term capital gain in that case? 26,299. So in this case, which solution is more beneficial to the SSE? Which is more beneficial? Section 48 provides that 2 is more beneficial or CIT versus Manjula Shah is beneficial? Which one is more beneficial? Solution as per the provision is beneficial or solution as per the case law is beneficial? Definitely solution as per the case law is beneficial. Because I get the indexation benefit for a longer span of time, my index cost acquisition is more, my capital gain will be less. Now the question is, what you should follow in the examination? Ultimately, as a student, you will be interested in that only. Saying that this story is correct, we have understood everything, but what should we do in the examination? What you should do in the examination, that my opinion I am giving you. Listen to me carefully. Up to last year, old module, May 20, November 20 module, CA Institute has done something else. May 21 onwards module, CA Institute has done something else. What CA Institute has done up to November 20 module now? They have made the main solution as per section 48 proviso 2. They have done the main solution as per section 48 proviso 2, taking the indexation from the year in which capital asset is acquired by the SSE. And then Once the solution is over, thereafter they have given a alternate solution, saying that alternatively indexation can be taken from the year in which capital asset is acquired by the previous owner. This is as per CIT versus Manjula Shah. And once again they have made the solution. So basically for the same question they used to give two different solutions. First solution will be as per section 48 proviso 2, then it is an alternate solution as per CIT versus Manjula Shah. Right now I am in the state of Tamil Nadu. Madras High Court is not having any corresponding decision like similar to CIT versus Manjula Shah. In practical life, if the SSE belongs to the state of Maharashtra or he belongs to Delhi, Delhi High Court we have a similar case called as Arun Shungulu Trust versus Commissioner of Income Tax. Similar judgment. So if you are in Delhi or Maharashtra, then you have the case law. Other states you don't have the corresponding case law. So in practical life, what people would be doing? People would be taking the indexation from which the capital asset is acquired by the previous owner. Basically, they would follow the second solution because that is advantageous to them. And if the income tax officer does not accept, they will give a reference of CIT versus Manjula Shah, Bombay High Court judgment. They will give a reference of Arun Shungulu Trust versus CIT, Delhi High Court judgment. And then also if income tax officer is not satisfied, then the only option left is go to a court and fight the case. Go to the court and fight the case. So in the examination, up to last year, CA Institute was providing two solutions. The new module which is issued for May 21, CA Institute has revamped. CA Institute does not have a single question in the module in which such kind of situation will arise. All questions in which such kind of situations were arising, they have removed the question from module itself. So this controversy is not addressed in the new module. So it will be directly asked to you in the examination only. So what you should do? In the examination, you should provide two solutions. In examination, you should provide two solutions. Main solution as per section 48 proviso 2, taking the indexation from the year in which asset is acquired by the SSE. And then you can provide the solution as part of alternative solution, taking the indexation from the year in which asset is acquired by the previous one. Have you understood this? Yes or no? Please respond. Okay. Now definitely you would like to write all these things. So I have already told you that all these things would definitely appear in the book only. You need not write anything. You have to just apply your mind. See, this is already written and given to you. Just refer page number 182. Page number 182. We can just go through this page. Page number 182. Capital gain on transfer of capital asset which was acquired by way of gift, will, inheritance, partition of which, etc. And it was not taxed under the head IFOS. It was not taxed under the head IFOS. So in the hands of Maitri, nothing was taxed under the IFOS because the value of gift was less than equal to 50,000. We have section 2 clause 42A for period of holding. This section will say that period of holding of SSE should include the period of holding of previous owner. In our example, period of holding of Maitri should include the period of holding of Manoj. Section 49 subsection 1 will say that deemed cost of acquisition of Maitri is cost of acquisition of Manoj. So deemed cost of acquisition of SSE is nothing but the actual cost of acquisition of previous owner. Controversy is on indexation. So here you have two solutions. Number one, as per section 48 proviso 2. Indexation will be available from the year in which capital asset is acquired by the SSE. If you want to circle, you can circle this word. As per CIT versus Manjula Shah, Bombay High Court, Indexation will be available from the year in which capital asset was acquired by the previous owner. Have you understood this very clearly? Yes or no? Okay. Now we have to discuss one similar situation actually. Same situation, this one only with slight change. If you want me to discuss right now, I will discuss right now. It is going to take say 10 minutes time. Or if you want me to discuss after the break, then we have a break. After 30 minutes we will discuss. Yes? After the break? Because that situation is connected to this one only. Situation is connected to this one. Yes? Most of you are of the opinion that we should be discussing that right now only. So let us proceed with our discussion. I will try to change this only. Whatever I have written here, I will change. I will make some changes. Only one change, very small change. Very small change. Same facts, I am not changing everything. I am just changing one information, that's all. I am just changing one information. So answer is also going to remain the same with slight change. Listen to me carefully. Mr. Manoj acquired a gold chain in the year 1516. The cost of acquisition is 20,000. This gold chain was gifted by Manoj to Maitri in the year 1920. But when the gold chain was gifted, at that point of time, the fair market value was not 30,000, fair market value was 60,000. This is one change I am making. This one change I am making. What will be the consequence? Everything else remains the same. So what is the consequence? 1516, no tax treatment. 1920, in the hands of Manoj, transfer by way of gift not considered as transfer. Section 47 is applicable. It is not considered as transfer. So section 45 subsection 1 fails. Capital gain is not taxable. In the hands of Maitri, what will happen? Since the fair market value is more than 50,000, how much is the fair market value? 60. So that 60 will become taxable to Maitri under IFRS. This is the change. This 60 will become taxable to Maitri under that IFRS. This is the first change. Correct? Next. Now you tell me one question you need to answer. This 60 we are taxing to Maitri in which year? 1920, correct? 1920. And we are taxing which value? We are taxing the fair market value. Don't you feel this fair market value of 60,000 will automatically include inflation for the period 1516 to 1920? Yes? Don't you feel the fair market value of 60,000 will definitely have the effect of inflation, effect of indexation from the year 1516 to 1920? Definitely yes. Definitely yes. Therefore, this solution is going to change. Maitri has sold the asset now. This solution will change. Where there will be a change now? Year will change. From 1516, this year will be taken to be which year? 1920. 1920. So here the period of holding will be from 1920 to 2021. Here we say that it is less than 36 months. Less than 36 months. So asset is not long-term asset, it is short-term asset. Less than 36 months, this is short-term capital asset and the gain is short-term capital gain. Now let me change the selling price. Let me make it 70,000 so that we have a profit. Here, since it is a short-term asset, there won't be any indexation. Since there won't be any indexation, the controversy of CIT versus Manjula Shah, Section 48 Proviso 2 will not prevail here. Section 49 subsection 1, nothing will apply. All this will go. Directly we deduct the cost acquisition. What should be taken as cost acquisition? Here section 49 subsection 4 will be applicable. Which section? Section 49 subsection 4. Section 49 4 says what? Whatever was taxable to you under IFRS, what was taxable to you under IFRS? 60,000. This amount was taxed to you under the head IFRS, This 60,000 should be taken as cost acquisition. This 60,000 should be taken as cost of acquisition. So full value of consideration is 70,000. Expense on transfer is 0. Net consideration is 70. Cost acquisition is 60 as per section 49 subsection 4 and your short term capital gain is 10,000. Yes, have you understood? There is no indexation, no argument of indexation. All this will vanish. Is that very clear? Second situation, have you understood clearly? Yes, so we have covered the second situation. You may feel that you need to write this. Sarvana is saying, sir, how the 70 has come? That 70 I have given you, Sarvana. So that there is a capital gain. If I keep the amount at 50, there will be a capital loss here. Why you want to take an example even of loss? Example we should take of big amounts, crores of rupees, always positive. So, we will refer this. This will take 1 minute's time. Section 2 clause 42A, section 49(4), amount taxed under that income from other sources shall be considered as cost acquisition. Indexation will be as per section 48 to only. 48 proviso to only. CIT versus Manjula Shah will not apply here. Have you understood this? This is the first situation, this is the second situation. Intentionally these situations are created, everything is accumulated and it is written at one place so that it is easier for you to revise day before examination. So before the break we have discussed the two situations. Both the situations are given to you in the notes on page number 182. Let's move on to question number 4. Question number 4. Question number 4 is based on those two situations only. See this. Question 4. X acquired a plot of land in 97-98 for 2 lakhs and gifted it to his major son Y on 1st June 20. X acquired a plot of land in 97-98. Whether plot of land is capital asset? Yes. Belonging to category 2. Period of holding applicable is 24 months. It was acquired in the year 1997-98. So it is acquired prior to 1st April 2001. 2 lakhs is the cost acquisition. This plot of land was gifted by X to his major son Y, and the gift is also given prior to 1st April 2001. Gift is also given prior to 1st April 2001. On the date of gift, the market value was 2,50,000. We are not concerned with market value on the date of gift, because when we move on to the chapter of income from capital gain, when we move on to the chapter of income from other sources, at that point of time, you will learn that any gift received from a relative is not taxable at all. Whether the value is less than 50,000 or more than 50,000, it does not make any difference. Any gift received from a person who is your relative is not taxable to you. The fair market value of this plot of land on 1st April 2001 is 3 lakh rupees. So definitely this will be taken into account. This land is sold on 15 September 20 for 35 lakhs. Compute the capital gain for the assessment at 21-22, assuming that the expenses on transfer are 1 lakh rupees. What would be the capital gain? This is the second part of the question. Forget about this. We should first solve the question considering that date of gift is 1st June 2000. This is date of gift. In this case, the year of acquisition of asset by the previous owner is prior to 2001, and the year of acquisition of asset by the SSE, major son Y, that is the year of gift, that is also prior to 1st April 2001. Are you understanding? Yes or no? Yes. First of all, let us now move on to that format of the solution on page number 219. Page number 219. Case A, if the date of gift is 1st June 2000. See here, CIT versus Manjula Shah will not apply, na? Why it will not apply? Because the asset was acquired with the previous owner prior to 1st April 2001. It was also gifted prior to 1st April 2001. And anyway, we are going to take fair market value. So everything is covered. Indexation will be available from the base year 2001-2002. Is that very clear? What is full value of consideration? Can you tell me the amount of full value of consideration? $35 lakhs. What is expense on transfer? 1 lakh. So net consideration is 34 lakhs. Index cost acquisition. First of all, you find out what is actual cost acquisition. Actual cost acquisition will apply section 49 subsection 1. Actual cost acquisition of Mr. Y is 0, but his deemed cost acquisition as per section 49 subsection 1 will be cost acquisition of previous owner. What is that cost acquisition of previous owner? 2 lakhs. This should be compared with FMV on 1st April 2001. What is FMV on 1st April 2001? 3 lakhs. Whichever is higher, 3 lakhs. Yes or no? On this 3 lakhs, we should apply the indexation, na? 3 lakhs into what? Indexation of which year? Year of transfer, that is 2021, 301. Divide by denominator index. Denominator index is generally of the year in which asset is acquired by the SSE. This is as per section 48 proviso 2 and as per CIT versus Manjula Shah from the year in which asset is acquired by the previous owner. But in this case, asset is acquired by the SSE as well as the previous owner before 1st April 2001. So we'll take the indexation from base year 2001 to, that is 100. So 3 lakh into 100 into 301 by 100 will be how much? Yes? 9 lakh 3,000. Do you have the index cost of improvement? No. So that is 0. So amount to be taken to the outer column is 9 lakh 3,000. So your long term capital gain is 24 lakh 97,000. Is that very clear? Yes? 2497. $24.97. Shall we proceed? Now let's read the last line, what it says. What would be the capital gain? What would be the capital gain if the land was gifted by X to his son on 15th May 16? Yes, date of gift is changed. Now the date of gift is on or after 1st April 2001. So in this case, what will happen? In this case, you have to provide two solutions. First solution as per section 48 proviso 2, taking the indexation from which year? 1617. And second solution by taking the indexation from base year 2001-2 by applying CIT versus Manjula Shah. Here the asset is acquired by the previous owner before 2001 and asset is acquired by the SSE after 2001. In the previous situation, SSE as well as previous owner both had acquired the asset before 2001. In this situation, SSE has acquired the asset before 2001 and previous owner has acquired the asset before 2001, SSE has acquired in 1617. So the year of acquisition of asset by the previous owner is before 2001. Year of acquisition of asset by the SSE is on or after 2001. So here we need to provide two solutions. Have you understood this point? Yes or no? Yes. So let us move on to make that solution. Let us move back to page number 219. Page number 219. Case B. If the date of gift is 15 May 2016. If the date of gift is 15 May 16. This solution we are making as per section 48 proviso 2. Period of holding will remain the same. Why na? Because nothing is taxed under IFOs in this case. The example in which I took na, Maitri and Manoj, amount was taxed under IFOs. Therefore, period of holding had also changed. Here it will not change. It will remain the same. 97, 98 to 14 September 20. This is more than 24 months. Full value of consideration will remain the same, 35 lakhs. Expense on transfer will remain the same, 1 lakh. Net consideration will be 34 lakhs. 34 lakhs. Yes. Now tell me, what is the actual cost acquisition? And what is FMV? On 1st April 2001. Actual cost acquisition is nothing but the cost acquisition of previous owner. 2 lakhs. FMV same, 3 lakhs. So 2 lakhs or 3 lakhs, whichever is higher? 2 lakhs or 3 lakhs, whichever is higher? You have to take 3 lakhs. Correct? On this 3 lakh, you apply the indexation. 3 lakhs into numerator index, which year? Year of transfer. What is that? 301. Divide by denominator index. Which year? Denominator index will be of which year? 1617. What is that index number? 1617. 264. 264. So what is index cost acquisition? $342,045. 342,045. Others are getting the answer, or I am just providing private tuition to Deva? $342,045. Have you got the answer? Yes. Okay. Index cost of improvement 0. Let us take this amount to the outer column. 342,045. Get the amount of capital gain. 30 lakhs. 57,954. Yes. Every one of you have got the same answer. $30 lakhs 57,954. In fact, it should be 955. $955. 30 lakhs 57,955. So we have the answer here. Round of difference it might be. I am having the answer as 30 lakh 57,954, which is wrong. It should be 955. Now you tell me, this is as per which, this solution which you have made, this is as per which provision? Section 48 proviso 2. Section 48 proviso 2. Sarvanna, cost we have taken as per section 41. That is correct. The indexation, section 48 proviso 2. Now same solution we should make as per CIT versus Manjula Shah. Now you tell me CIT versus Manjula Shah, you will take indexation from which year? If I make the same solution, date of gift is 15th May 16. And if I say I want to make this solution as per CIT versus Manjula Shah, then indexation will be available from which year? From the year in which capital asset is acquired by the previous owner. Previous owner has acquired capital asset in 97-98. That is prior to 1st April 2001. So indexation should be taken from base year 2001-2002. Yes or no? Are you all understanding? If I take the indexation from base year 2001-2002, in that case my answer which was in case number 1, that answer will remain the same, na? If I take the indexation from base year 2001-2002, my answer will remain the same as case 1, sorry, case A. Yes or no? So I am not solving it once again. No, I am not solving it once again. In examination also you should not solve once again. So your case B, if the date of gift is 15 May 16, as per CIT versus Manjula Shah, I am giving the answer. Here we are saying even if the date of gift is 15th May 16 instead of 1st June 20, answer will remain the same. As per CIT versus Manjula Shah, answer will remain the same. As per section 48 proviso 2, answer is different. So as per section 48 proviso 2, we have calculated the answer. As per CIT versus Manjula Shah, we are saying that we are not recalculating. Answer is going to remain the same. If the capital asset is acquired by any of the modes given in section 40 and 1, that is gift, will, inheritance, succession, devolution, partition, etc., then the cost of acquisition of previous owner should be considered as deemed cost of acquisition of SSE. As per section 2 clause 42A, period of holding should be considered from the year of acquisition of asset by the previous owner. And as per the decision of Bombay High Court, in CIT versus Manjula Shah, it was held that the benefit of indexation should be available from the year in which capital asset is acquired by the previous owner. And in our example, this question, capital asset is acquired by the previous owner before 1st April 2001. Therefore, we should take indexation from the base year 2001-2002. In that case, answer is going to remain the same in the second case, that is case B. Yes, have you all understood very clearly? Why to apply 49.4? 49.4 will be applied if something is taxed to you under income from other sources. 49.4 will be applied if something is taxable to you under income from other sources, na? Right now, nothing is taxable under income from other sources. Gift is given by father to child. So when a child is receiving gift from father, nothing is taxable under that income from other sources. Are you understanding? No. Sarvana, I don't want to discuss the provisions relating to gift, but I want to tell you that earlier also I told you, if you are receiving gift from relative, it is not taxable at all, even if the value is more than 50,000. Even if the value is more than 50,000, gift received from a relative is not taxable. So your child is receiving gift from father. For the child, father is considered as a relative. So gift received from father is not taxable. Is that very, very clear? Let us now move back to page number 184. Page number 184 in your book. We have question number 5 here. Very small question. Page number 184, there is a question. And for solving this, I have given you a format on page number 220. So I can give you 2 minutes time. Read the question and solve. If you want, you can solve. You can fill in the blanks with pencil. Question number 5. Solve question number 5 on your own. Question is given on page 184 and the solution is given, format of the solution is given on page number 220. Gold bond is transferred or gold is transferred? Refer to the question carefully. If you believe that gold bond is transferred, then you know that gold bond is not a capital asset. Then you know that gold bond is not a capital asset. So there should not be any capital gain. Yes or no? See, read the question. Do one thing. I will once again move on to that page number 184 of your book. Read the question. What it says? Dev received a gift from his brother of 6.5% gold bonds of the value of 5 lakhs in 1979. So he has received a gift of gold bond. Definitely that gold bond is not a capital asset. These bonds were redeemed by the government on 1st August 2011. This gold bond is already redeemed. And at the time of redemption, he received gold of equivalent value of 5,000 grams, 5 kg. This gold was sold. Where they have written gold bond is sold? Capital gain is gain on transfer of capital asset. What is transferred is not gold bond. What is transferred is gold. So gold is definitely capital asset. So gold was sold by him on 1st May 2020 for 60 lakhs. The market value of gold on 1st August 2011. What is 1st August 2011? Date of redemption of gold bonds. On that date, gold is received 5,000 grams. And the value of that gold on the date of redemption was 30 lakhs. This will become your cost of acquisition. Examine the impact of this transaction in Dev's assessment. So what is sold is not gold bond. What is sold is gold only. So whether gold is capital asset? Yes, definitely it is capital asset. It belongs to which category? Category 3. Period of holding applicable is 36 months. So see, period of holding should be taken from 1st August 2011. Don't take the period of holding from 1977. Because don't take the period of holding from 1979. In the question, first line says he has received gold bond from his brother. But this gold bond was acquired in which year? 1979, na? We are not concerned with that. Because at that point of time it was a gold bond. And we are calculating capital gain on transfer of gold. So gold was acquired on redemption on 1st August 11. One day prior to the date of transfer is 30th April. This is more than 36 months. So it is long term asset. This gold is sold for 60 lakhs. Expense on transfer is 0. Net consideration is 60 lakhs. Index cost acquisition. First of all, what should be the cost acquisition? 30 lakhs. Multiply by index number of the year of transfer. That is year 2021. Index number is 301. Divide by index number of the year of acquisition. That is which year? Two 2011-12. 2011-12, what is index number? 184. So 30 lakhs into 301 divided by 184 is giving me what amount? 49 lakhs 7,609. 49 lakhs 7,609. Index cost of improvement is 0. Let me take this amount to the outer column. 49 lakhs 7,609. So what is the amount of long term capital gain? 11 lakh. Ten lakhs. 10 lakhs 92,391. Those who got the answer as 11 lakh, read me. Have you understood what mistake you have done? I do not know what mistake you have done. How you have got the answer as 11 lakh 18,000, that I do not know. The correct answer is 10 lakh 92, 391 or 392. Rounding of difference is okay. Calculation error. Okay. Have you understood this? Yes. Question number 5. So let us move back to that page number 184. Now we'll do two small sections. Everyone has completed the solution, na? Now I'll be discussing two sections. First of all, I am discussing section 45 subsection 3. There is an individual. This individual wants to become a partner in the firm. He wants to become a partner in the firm. So what he has to do? He has to contribute capital to the firm. Individual has to contribute capital to the firm. Once he contributes capital, he will be considered as partner in the firm. This capital can be contributed either in cash or in the form of asset. If it is contributed in the form of asset, then you have to think whether the asset which is given by the individual to the firm, is it a capital asset or is it not a capital asset? Say for example, motor car used by individual for his personal purpose. He has become a partner in the firm and he has given this motor car to the firm. Then that motor car is not a capital asset, na? So no capital gain in the hands of individual. Example, personal car. But say for example, individual has transferred land and building to the partnership firm as capital contribution. Then what will happen? Partnership firm will pass an entry in its books of accounts. Land and building account debit to partners capital account. Land and building account debit to partners capital account. Entry will be passed. Now say for example, in this book, this land and building was acquired by the individual. Land and building, the cost of acquisition for the individual is say 10 lakh rupees. He has transferred this land and building to the firm. Amount recorded in the books of the firm is say 18 lakhs. Entries passed in the books of accounts of the firm at 18 lakhs. And the date on which this land and building was transferred to the firm, on that date, fair market value of this land and building is say 20 lakhs. So in this case, this individual is transferor and firm is transferee. Who has to calculate capital gain? Definitely individual has to calculate capital gain. But the question is what he should take as full value of consideration. His cost of acquisition is known to us. Cost of acquisition is 10 lakhs. Cost of acquisition is 10 lakhs. But what he should take as full value of consideration, that is the question. Here we have only two options. What are those two options? We are having the amount recorded in the books of the partnership firm as the value of land and building, which is 18 lakhs. And the second option is, what is the fair market value of that land and building? 20 lakhs. Either you have to take 18 lakhs or you have to take 20 lakhs. There is no other option. So you have to take what? That is what is written in section 45 subsection 3. Just to tell you what should be taken as full value of consideration, a new section was inserted, section 45 subsection 3. It says that while partner is calculating capital gain, what should be taken as full value of consideration? Amount recorded in books of firm. Amount recorded in the books of firm as capital contribution. This should be taken as full value of consideration. Can you tell me what is the amount recorded in the books of the firm in our example? 18 lakhs. So that 18 lakhs will be considered as full value of consideration. So you take 18 lakhs here. Calculate your capital gain, 8 lakhs. If it is long term, apply the indexation, that's all. So section 45 subsection 3 is made just to tell you one thing. When the individual is transferring capital set to the partnership firm as a capital contribution, what should be taken as full value of consideration for the purpose of computing capital gain? You have two options. Either you consider fair market value or you consider amount recorded in the books of the firm as capital contribution. So section 45 subsection 3 says what? You consider amount recorded in the books of the firm as capital contribution as full value of consideration for computing capital gain. That's all. Actually, it is a one-line section. It just says that amount recorded in the books of the firm should be considered as full value of consideration in the hands of the partner for the purpose of computing capital gain. Yes, have you understood this? Yes or no? Now listen to me carefully. See, you may have a doubt or a question may arise in your mind. If amount recorded in the books of the firm as capital contribution, which is 18 lakhs, if we consider this 18 lakhs as full value of consideration, then partner and partnership firm will do a collusion and intentionally record a lower value in the books of accounts. Instead of 18 lakhs, they will pass the entry in books of account at 10 lakhs only. If they pass the entry at 10 lakhs in books of account, full value of consideration will be 10 lakh, cost of acquisition is 10 lakh, capital gain will be 0, tax liability 0. Can they do this? Can partner and partnership firm cooperate with each other collide with each other to ensure that the tax liability of the partner becomes zero? Yes, that can be done. Definitely that can be done. In that case also, will we take amount recorded in the books of the firm as full value of consideration? Yes. In that case also, amount recorded in the books of the firm will be considered as full value of consideration. Then everyone will do this only. Section 45(3) will become redundant. Answer is yes, everyone can do this. Government says we don't have any objection. But if partnership firm is helping partner to reduce his tax liability, to that extent, firm will be caught by the tax. Because if firm records instead of 18 lakhs, firm is recording 10 lakhs in its own books of accounts. Then in future, if firm is selling this asset, their cost of acquisition will be 10 lakh instead of 18 lakhs. If their cost of acquisition in future is less, their capital gain in future will be more. So whatever tax they have, to whatever extent firm has helped the partner to reduce the tax liability, to that extent firm's tax liability will increase in future. Did you understand what I am trying to explain you? Partnership firm can help the partner to reduce the tax liability. For that, what they can do? They can pass the entry in the books of account at 10 lakh instead of 18 lakhs. In that case, partner's tax liability will become zero. But in future, whenever partnership firm sells this asset, in that case, firm's cost of acquisition will be taken as 10 lakhs. If the firm's cost of acquisition is taken as 10 lakhs in future, firm's capital gain will increase. So, practically no partnership firm would try to do this. Otherwise, only they will be at loss because their tax liability will increase in future. Have you understood this section 45(3)? Let's move on to next section. Section 45, subsection 4. Sarvana, who has incurred the cost of improvement? That is important, na? If firm has incurred the cost of improvement, then in future when firm sells the capital asset, at that point of time, that amount will be taken as part of cost of improvement. Firm has incurred, firm will get deduction. Partner has incurred, partner will get deduction. Simple. Controversy is not on cost. Controversy is on full value of consideration. To settle that controversy, section 45 subsection 3 says amount recorded in the books of the firm as capital contribution should be taken as full value of consideration. That's all. Next situation, 45(4). 45(4) is exactly opposite situation of 45(3). But before I actually move on to 45(4), let me tell you one more sentence in connection with 45(3). 45(3) definitely applies when a partner is transferring asset to firm. But 45(3) is equally applicable when a member of association of person, body of individual is transferring asset to association of person or body of individual. Either when a partner is transferring asset to firm or when a member is transferring asset to AOP or BOI, same provisions will be applicable. No change, same provisions will be applicable. Now let's move on to next section, that is section 45 subsection 4. Firm is transferring asset to partner. When firm will transfer asset to partner? Maybe at the time of dissolution of the firm, or maybe without dissolution also. Firm may transfer the asset to partner at the time of dissolution also, maybe without dissolution also. It will not make any difference, provision will remain the same. So in this case, firm will be considered as transferor, partner will be considered as transferee. Say for example, firm is transferring land and building to partner. So firm will pass an entry in its books of account. Na? What entry they will pass? partner's capital account debit to land and building account. Say for example, they have passed an entry in the books of account at 50 lakhs. Who has to calculate capital gain? Firm has to calculate capital gain. So what they should take as full value of consideration? That is the question. Here also they have two options. Option 1, fair market value or takeover price. Takeover price means price at which the asset is transferred by firm to the partner. In our example, takeover price is 50 lakhs. Let me tell you, fair market value is say 80 lakhs. So partnership firm should take what while calculating capital gain? Section 45 subsection 4 says take 80 lakhs. Take 80 lakhs. Sorry. What is 80 lakhs? 80 lakhs is nothing but fair market value. Is nothing but fair market value. So do you believe section 45.4 is also over? Section 45.4 is also over. Now my question to you is, do you believe that 45.3 and 45.4 are same? Or they are different? They are different in how many aspects? Number 1, 45.3 is applicable when the partner is transferring asset to firm. 45.4 is applicable when the firm is transferring asset to partner. Number 2, in 45.3, amount recorded in the books of the firm is considered as full value of consideration. In 45.4, amount recorded is not taken. What is taken? Fair market value is considered as full value of consideration. Yes or no? Yes. So we have completed 45.4, but I want to ask you a very simple question. While calculating capital gain in the hands of the firm, listen to me very carefully. It is open book examination for you. Think and answer. Firm has transferred the asset to partner. Firm has to calculate capital gain. Firm has calculated capital gain. While calculating capital gain, firm has taken fair market value as full value of consideration. 80 lakhs is taken as full value of consideration. Now the asset, land and building is in the hands of partner. In future, if partner sells that land and building, then partner will have to calculate capital gain in future. I am not talking about present, I am talking about future. This partner has received land and building from the firm. This partner may sell this land and building in future. So when he sells this land and building in future, what should be his cost of acquisition? That is the question. His cost of acquisition should be 80 lakhs or 50 lakhs. Should it be fair market value which was taken by the firm while computing capital gain? Or should it be this takeover price, 80 or 50? While calculating capital gain in the hands of the firm, you have taken 80. But partner's cost of acquisition will be 50 lakhs. This is always takeover price. Always takeover price. Have you understood? So what is going to happen? Partner's cost of acquisition will be less. Partner's cost of acquisition is less. So partner's capital gain will be more in future. So this difference of 50 lakh and 80 lakh, 30 lakhs. On that 30 lakhs, government is going to get a tax twice. On that 30 lakhs, government will be getting the tax twice. It is not double taxation. Double taxation means same income getting taxed twice in the hands of same person. When same income is getting taxed twice in the hands of same person, we say that there is a double taxation. Here, On 30 lakhs, government is getting tax from firm. In future, government will also get tax from partner. So, government is getting tax from two different persons. So, it is not double taxation. Double taxation means leaving the tax twice in the hands of same person. So, it is not double taxation, but by making such a provision, government is forcing you to do one thing. What? Pass an entry in the books of account at fair market value. If you pass an entry in the books of account at fair market value, such kind of difficulty will not arise. Such kind of situation will not arise. If you pass an entry in the books of account at 80 lakhs, for the firm, full value of consideration will be taken as 80 lakhs, and for the partner, cost will be taken as 80 lakhs. Simple. Have you understood this? Yes or no? Yes. So let's move on to this section 45.3 is over. 45.4 is also over. Let's move on to small questions. First of all, let's move on to question 7. This is the question I was talking about which the CA Institute had tested in the examination for 5 marks. All of them calculated capital gain. Mr. A has 2 motor cars which were used by him exclusively for his personal purpose. Exclusively for his personal purpose. What is the point? Cars which are exclusively used for personal purpose, they are not considered as capital assets. They are not considered as capital asset. There is no question of computation of capital gain. Still, examiners given the cost of the car was 1,50,000 and 1,80,000 respectively. First car was transferred by him on 5th January 21 to a partnership firm in which he is a partner. And this first car was given to the partnership firm as capital contribution. The market value of the car on 5th January 21 is 1 lakh, but this was recorded in the books of the firm at 2 lakhs. Compute the capital gain, if any, for the assessment at 21-22. See how intelligently question is drafted by the examiner. He is forcing you to go to section 45.3 instead of definition of capital asset, which is given in section 2 clause 14. Examiner is creating a situation clearly saying that this is transferred by firm to the transferred by individual to the firm as capital contribution, etc., etc. So that the moment you refer to this what will come to your mind is section 45 subsection 3, and you start calculating capital gain saying that this is the amount recorded in the books of the firm as capital contribution. Then you are gone. Before you start the calculation, you should always go through that flow chart to decide whether the asset is capital asset or not. If at all, if it is a capital asset, it belongs to category 1, 2 or 3. Then you apply the period of holding to decide whether it is a short-term asset or long-term asset. Then you start the calculation. So in this case, what is the answer? Motor cars which are used by SSE for exclusively for its personal purpose, they are not considered as capital asset. As per section 2 clause 14, they are excluded from the definition of capital asset. Therefore, there is no question of computation of capital gain. Okay. What it says further? Further part of the question says, would your answer be different if these motor cars were held by partner for his business purpose prior to transferment to the firm? Which section would be applicable in computation of capital gain in such cases? If this cars, no, Sarvana, you are wrong. If these cars were used by Mr. A for his business purpose, then these cars would be forming part of his block of asset. If these cars are forming part of block of asset, he might have claimed the depreciation. In that case, what will be the treatment? Is already discussed with you in the chapter of PGBP, section 32 versus section 50. Example number 1, case 1, case 2, case 3, case 4. Do you recollect? Yes. So let's refer to this solution. Question 7. Case A, if the motor cars are used exclusively by X for personal purpose. Motor cars are used exclusively by X for personal purpose. In that case, we say that motor cars held by SSE for his personal purpose is considered as personal effect, and personal effects are not considered as capital within the meaning of section 2 clause 14. Therefore, transfer of motor car by partner to the partnership firm will not attract the provisions of 45.3, because 45.3 contemplates transfer of capital asset. If capital asset is transferred, then only section 45.3 will come into play. Case B, if the motor cars are used by for business purpose, then they are considered as capital asset within the meaning of capital asset given in section 2 clause 14. And since motor car is a depreciable asset, capital gain would be computed in accordance with the provisions of section 5050. Yes, have you understood? Yes or no? Yes. So, there is one more question. That is question number 6. Question number 6 on page number 184. R acquired a residential house property by way of gift from his father. Any gift received from father is a gift received from relative. It is not taxable at all. That we'll discuss when we move on to the chapter of income from other sources, not now. R acquired a residential property by way of gift from his father in the year 67. So 67 is the year of gift. 67 is the year of gift. Father had acquired this property in the year 2000-2001 for 2 lakhs. So the cost of acquisition of father is 2 lakhs and property is acquired in 2000-2001. In other words, this property is acquired on or before 1st April 2001. So examiner should give you fair market value on 1st April 2001 in the question. This property was introduced as a capital contribution in a partnership firm in which R became a partner in the year 2020-21. The market value of asset in 2021 was 18 lakhs, but it was recorded in the books of the accounts of the firm at 20 lakhs. Is there any capital gain chargeable in the hands of R? If yes, compute the amount. See, if you refer to the question carefully, they have not given you fair market value. Which fair market value? Fair market value as on 1st April 2001 is not given to you. So I am slightly changing this question. You add one more sentence here. Father had acquired this property in the year 2000-2001 for 1,80,000. Instead of 2 lakh, make it 1,80,000. Father had acquired this property in the year 2000-2001 for 1,80,000. So I am changing the question slightly. Instead of 2 lakh, I am making this as 1,80,000. And I am adding one more sentence at the end. Fair market value as on 1st April 2001 is 2 lakhs. This is a drafting error in the question. Question is not drafted properly. So I have appropriately changed the question. Yes, now tell me, is there any capital gain? Is there any capital gain? Definitely yes. Definitely yes, there is a capital gain. Whenever asset is transferred by individual to the partnership firm as capital contribution, individual is transferred or he has to calculate capital gain, section 45 subsection 3 will be applicable. Section 45 subsection 3 will be applicable. Section 45 subsection 3 will be applicable. According to section 45 subsection 3, amount recorded in the books of the firm as capital contribution will be considered as full value of consideration. So let us move on to solution. Now first of all tell me, here CIT versus Manjula Shah case law will come or it will not come? Father had acquired property in which year? 2000, 2001. But the property was gifted by father to his son. In which year? 6-7. So as per section 48 proviso 2, indexation should be taken from the year in which asset is acquired by the SSE. That is 6-7. But as per CIT versus Manjula Shah, indexation should be taken from the year in which asset was acquired by the previous owner. Previous owner had acquired the property in 2000, 2001. But 2000, 2001 we don't have the index number, na? So we should take the indexation from 2001 too. So we have to make solution in two parts. In main solution we will be taking indexation from 6-7. As an alternative solution, we will be taking the indexation from which year? From the base year 2001, 2002. Yes? So you can move on to which page? Page number 220. You can move on to page number 220. Page number 220. Answer is yes, there will be capital gain. So we say R will be liable to capital gain tax as per section 45(3), where the capital is transferred by the partner to the firm as his capital contribution. Partner is liable to pay tax on capital gain arising on such transfer. For this purpose, value recorded in the books of the firm should be taken as full value of consideration. FMV on the date of transfer is totally ignored. Now can you tell me, first of all we are making solution as per section 48 proviso 2. Can you tell me what is the value recorded in the books of the firm? Market value is 18 lakhs. But this was recorded in the books of the firm at 20 lakhs. So 20 lakhs is value recorded in the books of the firm. 20 lakhs is the value recorded in the books of the firm. This will become full value of consideration. Expense on transfer is not given to us, correct? So net consideration is 20 lakhs. Now you have to take index cost acquisition. For that, forget, first of all you take the cost acquisition. What is cost acquisition? As per section 49 subsection 1, he has received the property by way of gifter. So as per section 49 subsection 1, his deemed cost acquisition will be cost acquisition of previous owner. Cost acquisition of previous owner is how much? 1,80,000. And this is prior to 1st April 2001. This will be compared with FMV on 1st April 2001, which is 2 lakhs. So out of this 2 will be taking whichever is higher, which is 2 lakhs. On this 2 lakhs we should apply the indexation. As per section 48 proviso 2, numerator index will be always year of transfer, 2021, that is 301. Denominator index will be Indexation for the year in which asset is acquired by the SSE. In which year SSE has acquired the asset? Yes? In 6-7. So you have to take the index number of 6-7. Denominator index will be of index of the year 6-7. What is the indexation of year 6-7? 122. Yes. So get me the amount of index cost acquisition. 493, 443. 493, 443. I don't have any cost of improvement. So I'll take this amount to the outer column. 493, 443. 493, 443. I will deduct this. Now balance is the capital gain. 15 lakhs, 6,557. 15 lakhs, 6,557. Yes? 15 lakhs, 6,557. This we have confirmed. This was as per section 48 proviso 2. Same solution we need to make as per CIT versus Manjula Shah also. So here I have written alternatively as per the decision of Bombay High Court. In the case of CIT versus Manjula Shah, it was held that the benefit of indexation would be made available from the year in which capital asset was acquired by the previous owner. So take the full value of consideration once again at the same level, 20 lakhs. Expense on transfer is 0, so net consideration is 20 lakhs. Yes. Cost acquisition of previous owner 1,80,000. FM is 2 lakhs. Whichever higher is 2 lakhs. 2 lakhs into index number of year of transfer, that is 2021, which is 301, divided by indexation for base year 2001, 2002, that is 100. Yes. So what is the amount which I'll get? 6,02,000. 6,02,000. Index cost of improvement is 0, so I'll take this 6,02,000 to the outer column. So my long term capital gain is 13,98,000. See, making solution is not a very big deal. It is very small solution. Only 7-8 line solution. You have to remember the provisions. The different situation, period of holding will change, cost will change, indexation period will change. So we have completed question number 6, 7. Section 45, subsection 4 is also over. Yes, everyone of you got the answer 1398. Yes. So I am moving back to page number 185 in your textbook. I am moving back to page number 185 in your textbook. I need to move on to page 189. Yes. Now we'll move on to next section, that is section 45, subsection 5. For that, you listen to me carefully. It's a very important section. What is the time right now? 1:18. Do one thing, I'll skip this section 45 subsection 5 right now. I will move on to section 45 subsection 2. Page number 186. Page number 186. Section 45 subsection 2. Listen to me very carefully. Yes, I am discussing which section with you? Section 45 subsection 2. Now say for example, Manoj completed his chartered accountancy. Manoj became a chartered accountant. From childhood days, he had one dream. Whenever he used to go in marriage functions, he used to think that when I will get married, I will decorate my wife with gold only. Sari which he is wearing, above that it will be full of gold. So Manoj, whenever he is having a dream, so in dream, he will get married to a girl and that girl will be wearing all clothes also, golden clothes and huge amount of jewelry. So from the moment Manoj has become a chartered accountant, whatever income he is earning, he is buying gold only. Whatever income he is earning, he is buying gold. So Manoj has bought jewelry worth lakhs of rupees. Only with the intention to ensure that when he gets married, his wife should be decorated with gold jewelry only. So he has acquired a lot of gold jewelry. This gold jewelry is a capital asset for Manoj. This gold jewelry is a capital asset for Manoj. For example, the cost of acquisition is say 50 lakhs. Whatever income Manoj is earning, everything is buying jewelry. Year of acquisition of this gold jewelry is say for example 2015-16. Now Manoj got married. On that day he decorated his wife with full of gold jewelry. His wife is very happy that she has got such a husband who gifted him gold jewelry worth 50 lakh rupees on the day of marriage. For a few days, both were excited. Slowly, excited was in the back burner, and the realities of life hit them very hard. Both of them are working. Slowly, they got interested into spiritual world. So Manoj and his wife both, they were going to different gurus. They used to hear a lot of spiritual things. And when you hear a lot of spiritual things, automatically your interest from this materialistic world will go away. So once in a week, twice in a week, thrice in a week, both Manoj and his wife both go to some spiritual guru, and whenever there is a speech, they will listen to that speech. So they both have lost interest in life, saying that there is nothing in life, whatever money we earn, everything will be here only. When we leave this world, nothing is going to come with us. So why to take so much amount of efforts? Why to take so much stress in life? What will do about these assets? And Manoj's wife is also saying the same thing. This jewelry will also not come with us. That is what is the language used by them now. Now say for example, 2017-18, Manoj left his job and he started gold jewelry business. He started a jewelry shop. Manoj started jewelry business. He started jewelry business. Business na he can open his shop whenever he wants. So no stress at all. He started jewelry business and Manoj's wife used to say that I also am not interested in this materialistic world. Everything is more maya in this world. So what Manoj did na, from his house na, from the locker, he took away the entire jewelry. He said to his wife that now we are not interested in this jewelry na, what we will do about this? Let us sell. Let us sell this jewelry. We will realize some money. We will use this money to tour the entire world. So she also readily agreed. So Manoj started jewelry business and took this jewelry in his business. So when he is taking this jewelry into his business, what entry he will pass? He will pass an entry stock in trade account debit. Stock in trade account debit to capital account. To capital account. For example, he has passed this entry at 80 lakhs. 80 lakhs. And in the year 2021, this jewelry is sold. Jewelry is sold for 100 lakhs. Now the question is, capital gain should be calculated or business income should be calculated? Because when the jewelry was purchased, it was a capital asset. But when the jewelry was sold, it was not a capital asset, it was stock in trade. So you cannot calculate capital gain. So to clarify all these things, whether business income should be calculated, whether capital gain should be calculated, if at all calculation of capital gain is required, what should be taken as period of holding, what should be taken as cost of acquisition, indexation should be taken from which year to which year. To clarify all these things, government came out with section 45 subsection 2, wherein government says, you had a gold jewelry which was a capital asset for you, but in the year 1718, that gold jewelry got converted into stock in trade. And when you sold the jewelry, it was a stock in trade for you. So, the profit on sale now is required to be bifurcated in two parts. Partly it should be taxable under that capital gain and partly it should be taxable under that PGBP. Partly it should be taxable under that capital gain and partly it should be taxable under that PGBP. Now before I actually want to discuss the provisions of section 45 subsection 2 in detail, whatever discussion we have had with respect to capital gain chapter yesterday and today, I want to ask you a very simple question out of it. You know that salary income is taxable either on due basis or on receipt basis, whichever is earlier. Salary income is taxable either on due basis or on receipt basis, whichever is earlier. But in the chapter of income from salary also, there are two things which are taxable on receipt basis. If question is silent, then arrears of salary means increase in salary with retrospective effect, and bonus and arrears of salary will become taxable in the year of receipt. That we learned in the chapter of income from salary. Income from house property, we learned that income from house property is taxable on accrual basis. It is taxable on accrual basis. But in the chapter of income from house property also, arrears of rent and recovery of unrealized rent is taxable on receipt basis. In the chapter of PGBP, we said that PGBP income is taxable based on the method of accounting followed by SSE. If SSE is following mercantile system, his income is taxable on accrual basis. Whereas if SSC is following cash system, his income is taxable on receipt basis. To that provision also, we had certain exceptions saying that bad debts recovery will become taxable in the year in which it is recovered. In other words, it will become taxable on receipt basis. Similarly, question is, capital gain is taxable on which basis? Capital gain is taxable on which basis? What is the criteria of charging tax on capital gain? Capital gain is taxable on which basis? This is the question. Capital gain is taxable on accrual basis or it is taxable on receipt basis? When it is taxable? On what basis capital gain is taxable? Read me, I will summarize the provision, don't worry about that. But first of all, you tell me capital gain is taxable on which basis? Capital gain is taxable on accrual basis, receipt basis, which basis? So listen to me very carefully now. Say for example, I have sold my property to Manoj. I am selling my property to Manoj. So who will calculate capital gain? Definitely I will calculate capital gain. I am selling my immovable property to Manoj. I am selling my residential flat to Manoj. Consideration equals to 100 lakhs. Out of this, 80 lakhs is actually received. 20 lakhs is still receivable. But since I know Manoj very well, what I have done, I have transferred possession of the property to Manoj, and we both also went to the office of registrar of property, and I have transferred property also in his name. Manoj said, sir, I have already paid you 80 lakhs. Actually, right now I don't have funds, but I promise you that I'll pay in next 5-6 months. So I told, yes, I have 100% faith on you. If you want, I will transfer property in your name. So I have transferred property in the name of Manoj. This transfer is done on, say, in the year 2021. In the year 2021, I received 80 lakhs and I transferred the property. 21-22, I have received the balance 20 lakhs. Capital gain will be taxable in which year? Will it be taxable in 2021 or will it be taxable in 21-22? Capital gain is taxable in the year of transfer. Dikshit, what do you want me to summarize? Do you want me to summarize 45-2? Or do you want me to summarize this year of taxability of capital gain? Don't worry, Dikshit, I will summarize 45-2. I will definitely summarize 45-2. But before that, I wanted a simple question, simple answer from you saying that capital gain is taxable in which year? Or it is taxable on which basis? What is the criteria of taxability of capital gain? But you did not give the answer correctly, that is the reason I am explaining you this. I asked you a very simple question, no one answered, that is the reason I moved on to some other discussion. I will move on to 45-2 once again. Yes, are you all understanding this? I asked you a question, capital gain is taxable on which basis? You did not answer me. That is the reason I am explaining all these things. So I have taken an example that I have transferred a residential property to Manoj. Consideration agreed is 100 lakhs. Manoj has paid me 80 lakhs in the year 2021 and he has paid me 20 lakhs in the year 21-22. Now I have transferred the ownership as well as possession to Manoj in 2021. Ownership is transferred. Possession means handing over the key of the flat. That is also transferred. Should I calculate capital gain in the year 2021 or should I calculate capital gain in the year 21-22? So answer is I should calculate capital gain in the year in which possession is transferred. So possession is transferred in 2021. So previous year 2021, I will calculate capital gain. While I calculate capital gain, I should take full value of consideration. What amount should be taken as full value of consideration? Should I take 80 lakhs as full value of consideration or should I take 100 lakhs as full value of consideration? That is the question. If you say that you take 80 lakhs, then you are indirectly saying that capital gain is taxable on receipt basis. If you say 100 lakhs, then you are saying that capital gain is taxable on accrual basis. So the point is, it is actually taxable on which basis? So the correct answer is capital gain is taxable on accrual basis. So while I calculate capital gain in this question, in this illustration, I should take 100 lakhs as my full value of consideration, not 80 lakhs. Yes, is that clear? So what is the answer? Capital gain is taxable on which basis? Answer is accrual basis. Capital gain is taxable on accrual basis. For others, I am explaining the provisions of section 45 subsection 2. I am once again back on section 45 subsection 2. 45 subsection 2, I was trying to explain you that Manoj had acquired the jewellery. When he acquired the jewellery, it was a capital asset for him. Then he started the jewellery business in the year 17-18 and that jewellery was taken to in his business. It became a stock in trade for him and that jewellery was sold in the year 2021 as stock in trade. In such case, should he calculate capital gain or should he calculate business income? That is clarified in section 45 subsection 2. That is clarified in section 45 subsection 2. Dikshit, I am discussing 45.2. For that, I would summarize 45.2 for you this example in 2 sentences. Number 1 sentence, Manoj acquired a jewellery for his personal purpose in the year 15-16 costing 50 lakhs. That was a capital asset for him. Then Manoj started the jewellery business in 17-18. He took this jewellery in his business. So this jewellery which was a capital asset got converted into stock in trade in the year 17-18. And finally this jewellery is sold in the year 2021 for 100 lakhs. When this jewellery was acquired, it was a capital asset. When this jewellery was sold, it was a stock in trade. How the tax treatment will be given in such a situation, that is what we are discussing. So government says you calculate capital gain and you also calculate PGBP income. You calculate capital gain and you also calculate PGBP income, but this calculation will be done in the year in which stock in trade is sold. We have section 2 clause 47. We have section 2 clause 47. What is section 2 clause 47? Section 2 clause 47 is definition of transfer. This says if you convert your capital asset into stock in trade, it will be considered as transfer. It will be considered as transfer. So according to this section 2 clause 47, which says that if you convert your capital asset into stock in trade, it will be considered as transfer. If you apply this provision, then what is the conclusion? Capital asset is transferred in which year? By applying this provision, you converted your capital asset into stock in trade in which year? 1718. So in the 1718, we will say that there is a transfer of capital asset. Generally, capital gain is calculated, capital gain is taxed in the year of transfer. Generally, capital gain is taxable in the year of transfer. But here in section 45 subsection 2, government says we will not calculate capital gain in the year of transfer. We will not levy tax on capital gain in the year of transfer, because if we levy tax in the year 1718, Mr. Manoj will not have money to pay the tax, because he has just passed the entry in his books of accounts. He has not realized money. He has just passed a journal entry in his books of accounts. If we levy capital gain in the year 1718, Manoj will not have money to pay the tax. Therefore, government says in section 45 subsection 2 that capital gain and PGBP income both will be calculated in the year in which stock in trade is sold. In other words, government has postponed the calculation of capital gain till the year of sale of stock in trade. If you don't sell the stock in trade, no PGBP income, no capital gain, nothing. Capital gain, PGBP income both will be calculated in the year of sale of stock in trade. So, in which year we will calculate capital gain and PGBP income? In the year of sale of stock in trade. What is that year? That year is nothing but previous year 2021. Previous year 2021, it is the year of sale of stock in trade. In this year, your calculation will be divided in two parts. Calculation of capital gain, this is part number 1, and part number 2, calculation of PGBP income. Now, before I move on to discussion of details with respect to calculation, I want to just tell you one sentence. Whenever your capital asset has got converted into stock in trade, capital gain will not be taxable in the year of conversion. Capital gain will be taxable in the year in which converted stock in trade is sold. Because only when you sell it, you will realize money and you will have money to pay the tax. Therefore, government is postponing the capital gain taxability from the year of transfer to the year of sale of stock in trade. So, previous year 2021 is the year of sale of stock in trade. In the previous year 2021, we will calculate capital gain as well as PGBP income. So, I am calculating capital gain. First of all, whether gold jewelry is a capital asset? Yes. It belongs to which category? Category 3. Period of holding to be applied is how much? 36 months. So, in this case, actual period of holding is how much? In this case, actual period of holding is how much? Say for example, let me change this year from 1718 to 1819. In this case, actual period of holding will be how much? It will be from 2015-16, year in which this gold jewelry was acquired, till the year in which gold jewelry was converted to stock in trade, that is 1819. See, in capital gain, you can't take period of holding till 2021, because in 2021 it was not a capital asset only. Deva, 2021 it is not a capital asset. It was capital asset only till 1819. It was capital asset only till 1819. Thereafter it was a stock in trade. So, period of holding you have to take from 15-16 to 18-19. Is that very, very clear? Yes or no? How much you should take as full value of consideration? So, in section 45 subsection 2, government says, whatever is the fair market value on the date of conversion of capital asset into stock in trade, that you should take as full value of consideration. This is not fair market value, this is book value. The entry which is passed in the books of account. that amount should not be taken into account. Which amount should be taken into account? Fair market value should be taken into account. For example, fair market value is say 70 lakhs. Fair market value is 70 lakhs. Then you take into account 70 lakhs. You don't take into account 80 lakhs. 80 lakhs amount should be ignored because it is your books and you are passing an entry in books of accounts. You are deciding the amount. So that amount you can decide as per your convenience. If you want to take more amount to capital gain, then you will put higher value in this entry. If you want to take more amount in PGBP income, you will put lower amount in this entry. We don't want to give you a chance to decide how much amount you should take into capital gain or how much amount you should take into PGBP income. Therefore, we are saying that we will ignore this book value, we will take the fair market value. And fair market value of which date? The date on which this this capital asset has got converted into stock in trade. So in our example, what is fair market value? 70 lakhs. So this 70 lakhs will be taken as full value of consideration. What is cost of acquisition? Cost of acquisition is 50 lakhs. But here the period of holding is more than 36 months. It is more than 36 months. Therefore, it is long-term capital asset. So on these 50 lakhs, we should definitely apply the indexation also. 50 lakhs into indexation of which year? Tell me what should be the numerator index. It should be of which year? Should it be of 1819 or should we apply the index number of 2021? Yes? We should apply the indexation of which year? In 2021, this is what? In 2021, this jewelry is stock in trade. This jewelry was capital asset only up to the year 1819. So definitely numerator index should be index number of 1819. And denominator index should be indexation of year of acquisition, that is 2015-16. You calculate the index cost of acquisition. Whatever is your index cost of acquisition, deduct that from full value of consideration, you will get long-term capital gain. Have you understood this part? Yes? Left hand side capital gain, have you understood? Yes. Now I move on to the right hand side. Right hand side, there should not be indexation because indexation concept is not there in the chapter of PGBP. Indexation concept is there only in the chapter of capital gain. Only when you transfer the capital asset, there is indexation, and that too only when it is a long-term asset. In case of stock in trade, it is not a capital asset, no indexation to it. PGBP calculation is simple. You take the selling price. At what price you sold this jewelry? 100 lakhs. 100 lakhs. What should be taken as cost here? Whatever is taken as full value of consideration in calculating capital gain, that same amount should be taken as cost of acquisition while computing business income. What you have taken as full value of consideration while computing capital gain? Fair market value on the date of conversion. So here also you take fair market value on date of conversion. That is nothing but how much? 70 lakhs. 70 lakhs. You deduct 70 lakhs here and the amount of profit will be taxable to you under that PGBP is 30 lakhs. 30 lakhs. See this now, this calculation will be automatically done. The selling price will be credited to your profit and loss account. Cost will be debited to your profit and loss account. Automatically, now profit and loss account will give you a profit of 30 lakhs. Have you understood this calculation? 45.2. Now I am summarizing 45.2. Dikshit, are you there? Dikshit? Yes. See, now I am summarizing everything. The entire section 45 subsection 2, I am summarizing. Listen to me very carefully. I will summarize in maximum 10 to 12 sentences. 10 to 12 sentences. Point number 1, when you convert your capital asset into stock in trade, that is considered as transfer as per section 2 clause 47, which gives you the definition of transfer. Point number 2, section 45 subsection 2 says, when your capital asset has got converted into stock in trade, capital gain will not be calculated in the year of transfer. It will be calculated in the year in which converted stock in trade is sold. As per section 45 subsection 2, in the year of sale of stock in trade, your calculation should be divided in two parts. Part number 1 is calculation of capital gain and part number 2 is calculation of business income. While calculating capital gain, your period of holding should be from the year of acquisition to the year of conversion of capital asset into stock in trade. You should not take period of holding till the year of sale. You should take the period of holding till the year of conversion. Next sentence is, full value of consideration is nothing but fair market value on the date of conversion. You should not take amount recorded in the books as full value of consideration for calculating capital gain. Fair market value of that capital asset on the date of conversion into stock in trade should be taken as full value of consideration. All other provisions of capital gain will remain the same, with one important point to be kept in mind is indexation will be available from the year of acquisition till the year of conversion if it is a long-term capital asset. Don't apply the indexation till the year of sale. Indexation will be available only till the year of conversion. And lastly, business income is nothing but selling price minus the cost price. What is cost price? It is nothing but fair market value on the date of conversion. In other words, fair market value on the date of conversion is considered as full value of consideration while calculating capital gain. Same fair market value is considered as cost price while calculating PGBP income. This is the summary of section 45 subsection 2. So we have completed section 45.2. Actually, I started section 45.2. I started section 45.2 thinking that I will complete the provision and partly I will discuss question number 10 and partly question number 10 I will give you as homework. Question number 10 I had an intention to discuss it partly and partly I had an intention to give you as homework. That is the reason I skipped the 45.5 and started 45.2. Anyway, so conversion is considered as transfer. Capital gain is taxable in the year of sale of stock in trade. Full value of consideration is fair market value on the date of conversion. Period of holding should be taken from date of acquisition to date of conversion. Business income is nothing but actual selling price minus the fair market value on the date of conversion. These things are discussed with you. This is pending. I will discuss tomorrow. Question number 9, give me the answer. Question number 9, which is the correct, what is the correct answer? Question number 9. Question number 9. Yes, which option is correct option? Option B. In case of conversion of capital asset into stock in trade, determine the year till which indexation will be available. It will be available year of conversion of capital asset into stock in trade. Yes. If I ask you the same question, if I give you the same options and I ask you the question, in which year capital gain will be computed? In which year capital gain will be computed or capital gain will be taxable? Then what is the correct answer? Then the correct answer is option A, year of sale of stock in trade. Year of sale of stock in trade. Now, what I will do now? Since I could not discuss question number 10 with you, I wanted to discuss one part. Since I could not do that, I will give you some idea of question number 10 and you can try this question number 10 at home. Definitely we are going to discuss in detail tomorrow, but you can try at home. I am giving you some hints to solve the question. Listen to me carefully. I am giving you some hints to solve the question. I am summarizing question in a span of 1.5 minutes for you. In this case, SSE has acquired a plot of land, and you know that plot of land is a capital asset. He has acquired 30 acres of plot of land. He has acquired 30 acres of plot of land. Then he started business. Then he started construction business. Then he started construction business. He took this 30 acres of plot of land into his business. So this 30 acres of plot of land was a capital asset for him earlier. When he transferred this into business, this became a stock in trade. This became stock in trade. Thereafter, this plot of land, he incurred some cost on that plot of land to bifurcate that entire plot of land into small plots. So this entire plot of land was bifurcated into small plots, and then he had an intention of selling these different plots to different customers. Now question is asked in two different situations, case A, case B. Case A and case B. Case B says entire plot of land of 30 acres is unsold. So case B answer is very simple. What is the answer in case B? Entire plot of land 30 acres is unsold. What is the answer? If the entire plot of land is unsold, the answer is no capital gain, no PGVP income, because capital gain and PGVP income will be calculated in the year in which capital asset is converted capital asset is sold. In other words, stock in trade is sold. If the stock in trade is unsold, no capital gain, no PGVP income. That is the answer for case B. That is the answer for case B. Case A, what they are saying now, out of 30 acres, 10 acres is sold. 10 acres is sold. Remaining 20 acres is unsold. So can you tell me what is the answer for this 20 acres? What is the answer for this 20 acres? Since this is unsold, no capital gain, no PGVP income. Why? Because capital gain will be computed in the year of sale of stock in trade. Since it is unsold, no capital gain, no PGVP income. So whatever is the answer for case B, same is the answer for case A, but for only 20 acres. This 10 acres is sold, but this 10 acres is sold in two different years, 40% and 60%. It says 40% is sold, 60% is sold in the 1920 and 2021. 40% is sold in 1920, 60% is sold in 2021. 40% means how many acres? 4 acres. 60% means 6 acres. This is the summary of the entire question for you. Now, see, this question is very simple. The examiner is confusing you, not in capital gain PGVP. What he has done now to create the confusion? Some information he has given for 30 acres and some information he has given for 10 acres. And you are required to do calculation for 4 acres in 1920 and 6 acres in 2021. So when you do the calculation for 4 acres, all that information which is given to you for 30 acres now, you have to convert it into 4 acres. All that information which is given to you for 10 acres, that is also required to be converted into 4 acres. So proportionate amount you have to calculate. So somewhere information is given for 30 acres, somewhere information is given for 10 acres. All those information While you calculate income for 1920 for 4 acres, you have to convert those information into 4 acres. While you calculate income in the year 2021 for 60%, that is 6 acres, you convert all the information which is given into 30 acres or 10 acres, convert that into 6 acres. Only this point is required to be kept in mind, that's all. Question is very simple. If you don't do the conversion properly, you will get the wrong answer. Otherwise, there is nothing in this question. So we need to wind up this session today, and I am giving you question number 10 as homework. Tomorrow morning when we will meet, we will discuss the solution for this question number 10 and then we will proceed further. So we will wind up here. Bye bye everyone.